a day cut across the board from OPEC Plus was being tossed around over the weekend. And so the fact that that didn't come through, and instead we've got this Saudi lollipop of a 1 million barrel a day cut unilaterally on their part for the month of July, I think that the market sees that as less significant than a across the board OPEC Plus cut extended maybe for 6 months. I do think, though, that the market is a bit downplaying the significance of the deal that renegotiated the baseline production levels, because starting in 2024, these are going to come into effect. And that's really going to bring more clarity to the market, because one of the issues that we've seen with OPEC is that they push through a 1 million barrel a day cut, but it's not actually going to be 1 million barrels a day because a lot of the countries that are participating are not actually producing up to their max level. Their capacity is down because their production quotas are, back from 2016, and now it's 2023, and things are really different. So I think that once these new baselines come into effect, OPEC's production rates will actually be more reflective of what's actually on the market, and the market will appreciate that clarity.
Do we have a sense, Ellen, of just how much demand has actually fallen off versus the forward look of demand potentially falling off? If there's a recession? In other words, are prices accurately reflecting the slowdown that some people are saying is transpiring in China and other places?
I think prices are reflecting the fear of the slowdown much more than what any actual slowdown is, mostly because we're not really sure what that slowdown is going to be. We also don't know how China is going to react to this. Is China going to push through some kind of big manufacturing stimulus that will push up demand? Plus, there's always this kind of fake, I don't want to say it's fake, but China tends to buy more crude oil when it's cheap to put into storage, maybe for rainy days or whatnot, or just to resell, to process and resell around Asia. And so there's a lot of cheap crude available on the market now. Russia is a huge purveyor of it, but also there's Iranian and Venezuelan crude that China can get. And so they may actually be buying more crude oil than they're using, and that's kind of papering over any kind of demand issues that we're seeing.
Yeah, one big wild card I've been wondering about, and maybe you've got some good color on, is what's going on with the Strategic Petroleum Reserve? Where do we stand? What are you hearing about us trying to rebuild that? Because to me, it's a bit concerning that it got so low and it's staying this low, and we're not really taking advantage of lower oil prices.
Yeah, that's a big issue. I think part of it is that maintenance needs to be done in some of the storage facilities, and so the government is hesitant to start making purchases before it's completed those maintenance things, which is an issue, and I do think needs to be addressed. But I don't think that I do think that they can purchase more than they are, and the fact that they're not, particularly when prices are in a good spot, is concerning. I also think that when they do start to purchase finally, which I do believe they will, whether it's this particular government or another administration, we are going to see a big bump in demand, and that's going to push prices up, because this is going to be a lot of crude purchases, and I don't think that they're prepared to do this. And I also think that OPEC is kind of waiting for this to happen. They got very upset when the government when the Biden administration basically said, "Hey, we're going to start purchasing when it hits this level," and then they didn't. And OPEC was like, "Well, we were expecting this demand bump. Now we're going to have to cut supply." And I think they were burned and a bit upset about that.
Interesting. Ellen Wald of the Atlantic Council, thank you. Really interesting that was actually something that they were frustrated about, that there was a signaling and lack of follow through, and they were just like, forget it, we're going to go our way.
Yeah, and I think that has been one of the things overall with the U.S. is we send these mixed signals, and countries are starting to move away from us a little bit because they don't trust us to follow through on our signals, and we're too short-term focused.
And this is something that we'll talk about just generally with the geopolitical sphere next with Anne-Marie. But I am curious, from your vantage point, how much oil prices really are a signal at this point versus noise, considering all of the distortions with Russia, with some of the other supply and demand dynamics?
It feels like we've set into this new status quo of we know what supply issues are out out there, what the problems are, where Russian oil is going. So I think it is back to being a bit of a signal. And when we see this lower oil, as well as copper, right? Copper's kind of been trending lower. What is going on? And did too many people kind of front run this, trade? But it is worrying to me, really, at every level that the SPRs fails to get built back up, because that's something we really should have in case we need it again.
So do you think that this is something that is a next year problem, or do you think this is just sort of a longer term existential question mark of not having that protection?
You always buy insurance because you don't know when you're going to need it. So why don't we have any insurance right now? And that's up front. So I would say you want to build it back up while we can, just in case. We don't know what will happen geopolitically. We don't know what will happen across the world or in the economies that might cause us to need lower oil prices again.
Well, coming up, we're going to discuss that more. Peter Scheer is going to be staying with us of Academy Securities. Coming up later this morning, 7:45 a.m. Eastern, Tony Capuana, who is president and CEO of Marriott International. We're hearing from all of the airline CEOs that demand will not quit. Perhaps we'll hear the same from Tony.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Russia and Ukraine are reporting widespread fighting along the war's front lines as anticipation mounts for a long-planned Ukrainian counteroffensive. Moscow says its forces defeated a large-scale Ukrainian attack in the Donetsk region on Sunday. Ukraine says it repelled all Russian attacks. Ukraine is gearing up to try and reclaim Russian-occupied regions of the country, backed by billions in weapons supplied by Kyiv's U.S. and European allies. Oil advanced to open the week after Saudi Arabia said it will make an extra 1 million barrel a day oil supply cut in July. And that announcement came after a tense OPEC Plus meeting over the weekend. The move takes its production to the lowest level for several years following a slide in prices. Hong Kong's office towers, among the most expensive commercial real estate in the world, have never been this empty. Data from Colliers shows a record 13 million square feet of office space sits empty, with an overall vacancy rate of nearly 15%. Now, that's more than 3 times higher than in 2019 and tops New York City's rate of 12.5%. Western banks have been cutting space as deal-making slows, and China tightened its grip on the financial hub. Apple shares are set to hit an all-time high. It comes ahead of the company's worldwide developers conference today, where it's set to introduce a mixed reality headset. Now, it's Apple's most significant product launch event in nearly a decade. At the current price, Apple is poised to add $16.5 billion of market cap, putting it even closer to a historic $3 trillion valuation. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. Bloomberg covers the world with unmatched reach and resources. From more than 100 120 countries. The moment news breaks, 24 hours a day. Bloomberg, your global business authority. Tuesday, following the worst ever year on record, bonds are back. Bloomberg is live from PIMCO headquarters in Newport Beach, California, sitting down for exclusive interviews with CEO Manny Roman, income fund manager Dan Iveson, and more as the biggest names in fixed income reveal their bond market forecasts. It's a special episode of Bloomberg The Open with Jonathan Farrow at 9 a.m. Eastern, only on Bloomberg Television.
At the end of the day, we need to have a serious discussion about how much debt we can have in this country, how much we can afford, and how it's spent. And that discussion needs to go on. The debt ceiling triggers certain debates around it at certain times. It's part of the process of government, and whether you're Republican or Democrats have to get together and do it. And we have to be careful that we keep the financial stability and strength of the United States paramount, because at the end of the day, if we're not strong, the rest of the world is not going to be strong.
That was Brian Moynihan, Bank of America CEO, speaking on CBS's Face the Nation after the president did sign some sort of debt ceiling reconciliation. We are not going to default. That is the good news. The bad news, if you're concerned, is that there is going to be a net $1 trillion of bill issuance. Peter Scheer of Academy Securities here with us. Tom and John both off today. Peter, how concerned are you about that net $1 trillion in issuance?
I think we'll digest it fairly well, right? It's kind of well telegraphed. People have been comfortable, waiting for this. And what we saw too was the investment grade calendar was huge in the last month or so. So I think you saw investment grade issuers come take advantage of the fact that Treasury couldn't, and that'll be replaced. So I think there's going to be a relatively smooth transition.
How much is this basically, there isn't that much to say after a while, and it was debt ceiling dominating it because this news cycle was kind of slow, and now people are saying that we need something else to talk about, so let's worry about the net issuance of T-bills. I mean, how much is this basically manufacturing something to talk about?
I would lean much more that way. I just think we're going to digest it. We might move 5-10 bips or whatever, but it's not going to move markets. We'll get through it, and then we'll get back to a normal pace in a month or two.
Can you say the same thing about some of the tensions that we saw at the Shangri-La discussions in Singapore when the foreign defense ministers came together, including those from the U.S. and China? There wasn't much communication, if anything, other than a handshake. And I do want to read this to you. The Singapore Minister of Defense came out and said he was very concerned about the lack of communication between China and U.S. officials, saying not having communication between friends and more so potential adversaries. I think it's like F1 drivers on the same circuit driving blindfolded. You better be careful. That was just for John and Tom. I am curious, though, is this something that you see as perhaps a little bit more significant?
Yeah, and I'm very lucky because at Academy Securities we have 17 retired generals and admirals who serve as our geopolitical advisory board, and about half the firm are veterans. So I've learned a lot. And one thing we often talk about is the deck plate level. So when you have good relationships, you want the armies actually be able to communicate, and at the deck plate level. So captains of ships know each other, and that's how you develop strong relationships. And it tends to be useful if you do have these adversarial conditions. So like when you mentioned earlier too, Taiwan, the ship got in the way, right? Okay, that's a real risk, is that you get some sort of inadvertent action that takes place, and China is doing a good job, so they're expanding their efforts in that area, and the more activity they have, and if we counter that with more activity, you get these risks of something going wrong. And when you don't have that deck plate level communication, it becomes really risky. I think it's been a problem across the globe right now, where we're not talking to enough leaders of other countries. We're not talking to enough people. We've kind of lost it a little bit in Russia. And the other thing I think that came out of this conference was, I think the world is growing very tired of the Russia-Ukraine war. I don't know how people come to a solution, but it feels you're getting more and more, you don't want to say crackpot type proposals, but countries saying, hey, figure out some way to stop this.
Well, let's get some details on what was actually discussed. Anne-Marie Hordern, who is down in Washington, D.C., our correspondent there, joining us now. Anne-Marie, what stuck out to you from these discussions, especially given that they didn't really tamp down tensions at all based on that U.S. ship that was interceded by Chinese officials?
It didn't tamp down any of these concerns and really the rhetoric you have between Washington and Beijing, even though we did see this friendly handshake between Lloyd Austin and his counterpart out of China, Li Shangfu. But when Lloyd Austin got up to speak, he said a friendly handshake isn't enough for substantive discussions. The United States wanted to have, at this Shangri-La dialogue in Singapore over the weekend, a sit-down between these two defense ministers. They want to start having this engagement with China. We've seen a number of these outreaches happening on the part of the administration. From the Chinese perspective, they said they weren't willing to meet unless sanctions that were put on Minister Li in 2018 for overseeing some transfer of Russian military equipment, unless those were lifted, they were not going to have a meeting. And I actually asked the president about this in Japan. Would you consider lifting these sanctions? He said it was under discussion, but clearly it did not happen. So the Chinese were saying, we are not going to have a meeting. So, Lisa, there was just this friendly handshake, but the rhetoric was red hot. Something Li said, I would like to bring to you. We will never hesitate to defend our legitimate rights and interests, let alone sacrificing the nation's core interests. As the lyrics of a well-known Chinese song goes, when friends visit us, we welcome them with fine wine. When jackals or wolves come, we will face them with shotguns. And this all happened as you had a warship of the United States transiting through the strait when a Chinese vessel came very close. And to Peter's point, that is the concern of every other defense minister in the room. There could be an accident that could happen that brings these two even closer in terms of a potential conflict.
Yeah, I think the Chinese rhetoric has been picking up. Remember when they put out the peace plan for Ukraine? They were very careful to make sure it was worded in such a way that China could take over Taiwan and would not violate any of their peace things. They've been very focused on our national alliances, so whether it's NATO and things like that. Where do you see them going? Because we see them expanding their international efforts in a way we hadn't really seen in the past.
Well, they view this moment as a time where they need to shore up their own alliances and allegiances in the Asia Pacific, as they see the United States do that as well, not just on the military front, but obviously also on the economic front. The United States wants to take this multilateral approach and make sure Western countries, European nations are in line with them when they go after things like export controls or what they're potentially going to do. And we're waiting for details of this restriction on outbound investment. China is going to do their own version of that. They obviously have Belt and Road, but we have seen them double down on backing of President Putin. They still have not come out and condemn this war. And that peace plan, as you say, very much so for China, really gave Russia an out. It could stop the war right now, but Russia would be able to hold on to any territory that it had. And for the Ukrainians, it is just a non-starter.
Anne-Marie Horduran, thank you so much for being with us. As always, we'll catch up with you throughout the week. I do want to get your view, Peter, on how you play this, right? I mean, I hate to sound sort of mercenary with it, because ultimately there's a bigger, kind of more substantial and existential concern here. But is this something that's market moving, or is it just something kind of hanging out there as a potential tail risk?
I think it's market moving, and first, partly because it's corporate moving. So I think corporations were already reducing their exposure to China. I think they're considering where they want to be in Southeast Asia. I think it's one reason the Japanese stock market has gone so well, right? As you start looking at China's and their ability to flex their might in the region, Japan's in a really interesting place, right? They had low inflation for a long time. They're finally getting some. They've got an educated workforce, and they are definitely militarily and politically powerful enough to act as a real front to China. So I think you're going to see growth there. I think people are going to shift around that. So that's kind of where we're looking at, what those alliances are. And at the bottom end of this is what's China doing in terms of trade in yuan, right? They are really trying to get more and more trade in the yuan. They're not going to go after the dollar as the reserve currency anytime soon. But I think you've got to be figuring out how you deal with emerging markets countries, how you compete with them when China starts offering goods and services in yuan, and that emerging markets country says that might be easier to deal with than the dollar. So I think that's a repercussion. So and maybe it's why emerging markets bonds have done so well this past year.
Do you think that people have underestimated the small amount of trade that's gotten done in in crude valuations in the UN?
Yeah, I think people underestimate it because it's just part of a multi-pronged approach, right? China is going to try and get yuan trading, gold trading. They're going to do contracts directly with other countries. It's only going to be a small portion, but they're going to roll it up, and then one day, 5 years, 10 years from now, you're going to look like, whoa, how did this all happen? And it'll be very clear all the steps that were taking place to this to happen. Again, China spends a lot of time lobbying these international agencies. China tries to be on, the important committees at the United Nations. All these things that I think we kind of take for granted or don't really think much about. China's doing it, and it really sets that framework, and they're going to go after the weakest link. So I think it's going to be emerging markets countries are going to see some appeal to de-dollarizing themselves.
Do you think that the dollar is then going to be the range bound or inflected lower from here?
I think it goes lower from here. I think not only that, I think ultimately our own problems, our debt ceiling, people are losing some trust in the dollar and what we stand for.
All right, well, we will discuss that coming up. We also have Tom Sasouras of Strategas joining us, talking about the fixed income space and perhaps also the U.S. and how that dollar story plays into that space as well. A bit of softness today, although pretty much range bound. This is Bloomberg.
Big ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back. Tom and John are off. They left me alone in my bearish prognostications. Lisa Abramowitz here, Peter Scheer alongside me for the hour as we head into a quiet period for the Federal Reserve, but anything but when it comes to both economic data as well as, of course, corporate moves. What we are seeing in the market right now, pretty much flat, a little bit of softness right now in the NASDAQ, reassessing some of the gains that we have seen so far year to date. The Russell 2000 underperforming yet again, a real question mark in some of of the over the weekend notes really questioning if we can enter a new bull market without the participation of the Russell 2000, down about 0.2% in crude prices. Now materially higher, near session highs, 2.4% gain on the NYMEX after Saudi Arabia came out and said that they were going to cut by 1 million barrels unilaterally without the participation of the United Arab Emirates. In the yield space, you are seeing yields about 5 basis points higher throughout the curve, a little bit less at the long end. We're looking at 3.75% on the 10-year. And taking a look at that ongoing dollar strength, euro weakness, Peter Scheer alongside us was just saying that he doesn't think it's going to last, and we will get to that in a minute. I do want to just run through some other names. We are seeing in the specific equity space, Exxon and Chevron responding to what we saw over at OPEC+, although not as much as you might think. Exxon up 1.5%, Chevron up 1.3%. Apple shares up almost 1%. What's notable here is they are near a near-time all-time high. They're actually bumping up against records ahead of their conference that they're going to have later today. Pete, what do you make of this, the tech rally that Apple shares are up 40% so far this year?
You know, it's really interesting, too, given that the mantra for the last 2 years was higher yields is really bad for big tech. So they've fought their way through that. They've done phenomenally well. They continue to kind of make twists and turns in terms of product offering, what they're doing, where they're going to come at it. So it's an incredible company to watch. And I still like the energy companies, though, as well, not just because what's going on in oil, but I think people forgot back in the day the energy companies of the future are likely to be the energy companies of the past. They're the ones that have the resources, the skills, the investment style to grow the sustainable energy that we need. So I've been a big fan. You got to buy them a couple years ago very, very cheaply, but I still think they offer attractive value because they will use this time. They'll profit from what's going on in the traditional energy markets, but they will be the drivers ultimately of sustainable energy.
Exxon shares down 2.5% so far this year. Do you think the bigger the better in terms of valuation going forward?
Yeah, I think them. I like that entire sector. We got out of some of it late last year when things were kind of taking a turn for the worse in terms of energy prices, but now's a good time to re-enter. And you get not just what's going on in oil, but everything else. And I think in the 5-10-year plan, that's going to be what works out the best.
So do you think, okay, and before we move on to the yield space, because I am curious what's going on there, but do you think that right now it's sort of everything is looking okay? You've got the tech space that used to be yield sensitive, isn't anymore. People like it. They're managing to deliver on the AI and some of the other types of initiatives and progress. But then on these other areas, their valuations don't look as extended as you see in the other areas.
Yeah, I'm not yet bullish, but I do want to get bullish at some point. And I do think, though, I want to be bullish the equal weighted indices, the Russell 2000s. That's kind of why are those lagging so much? Why has this been so concentrated and people getting chased into positions? So you're seeing real extreme divergence between the NASDAQ 100, market cap weighted and equal weighted. And I'm not yet ready to pull the trigger, but I think that's where I want to be, is in the equal weighted ones and try and take advantage of some of these laggards.
I'm not yet bullish, but I want to get bullish at some point. Tom Censura is joining us now, head of fixed income research at Strategas, a Baird company. And I'm wondering, do you agree? Is it sort of a moment where you're not quite bullish, but you really want to get bullish because things aren't turning and you are seeing that resilience in the economy?
Well, actually, I'm going to take the opposite approach here. I'm expecting the U.S. economy to, in the second half of the year, roll over into a recession. And I'm still expecting to see risk assets wobble lower as a consequence of that, and also expecting to see Treasury yields also move a good bit lower, particularly in the belly of the curve, 5, 7, 10-year portion of the curve. So we're still expecting that recession to come to drive risk assets lower and drive yields lower along with it later on this year. But as we saw from Friday's jobs report, that recession is not imminent. And now we continue to have to push that expectation of the timing of that back further into the future.
Well, that's exactly where I wanted to go. What's going to drive us there if it's not jobs, if it's not necessarily a rollover in some of the more interest rate sensitive sectors?
Well, I think eventually it is going to be jobs, because we still have a situation here where households, particularly lower income and middle income households, are spending more than they take in, and their credit card debt is growing. And although they're not large drivers of the economy, they can move it on the margin. That's number one. Number two, you are looking at modest fiscal drag coming from the debt ceiling agreement. That should hit in the second half of this year and early next year. On top of that, you've got student loan repayments restarting in the fall, so that should also be a drag on consumption. But the bottom line for companies is companies continue to retain employees, which are continuing to show negative productivity. And we can see this in operating margins, but you also see this in productivity numbers. So this is not sustainable long term, but can we continue to do this for 3 weeks? Absolutely. 3 more months? Probably. 3 more years? No. So somewhere between 3 months and 3 years, employers are going to have to pull back because they're continuing to hold employees who are not producing. And that's a recipe for job losses in the future.
Yeah, I'm definitely a little bit bearish about the markets, and that's remain on that side. Looking at yield curve, for example, I agree with you. I think lower yields long term. We've seen 2s10s go back to around minus 80 basis points. And a year ago, whenever we got inversion, everyone talked about it. No one seems to be talking about this inversion right now. Do you make much of that?
We always make a big deal about inversions. We always argue inversions, more than anything else, are a sign of a policy mistake by the central bank, which eventually, if left unchecked, will cause a recession. Timing of that is very difficult to predict because it's variable, but also because it depends on whether the central bank continues to tighten. So at this point in time, this inverted yield curve and this deeper inversion that we've seen over the last 3 months since March is telling us the market says the Fed is intent on continuing to tighten into a slowing economy. And that's a definition of a policy mistake, in my opinion. So I do think the Fed is driving us towards a stall speed in this economy. And when you're at a stall speed, you become unstable.
Do you think that the Fed still matters? If they hike one more time, do you think it really will make that much of a difference, Tom?
On the margin, no. It probably keeps the dollar from pushing lower in the near term. It probably puts a little bit more of a net interest margin compression into the financial space. But beyond that, it's probably not going to break the system. But nonetheless, it also delays the point at which the Fed is going to begin rate cuts. And that does matter, perhaps more than an additional rate hike. So right now, the market is saying rate cuts will say by November or December. And if the Fed tightens in July, then I think you got to push that back another month, maybe even 3 months into January or March.
So what's your top bet right now? Where are you putting your money in order to stave off some of the complaints from clients saying, hey, things haven't been doing that badly, so why can't we get those returns?
Well, we continue to love investment grade corporate credit here. And although at some point in time, we're going to have to pull back our overweight in that space, right now, we continue to see no reason why the economy is going to enter into a recession in the near term. And that means investment grade credit is both a safe haven as well as a good place to pick up yield and credit spread. And so we like longer duration investment grade credit. We're overweight in that sector. We continue to be. Beyond that, we're really not very positive on the fixed income space in general, because I do make the argument that yields could just as easily pop another 20 basis points higher here before they turn lower. So we're really not optimistic or bullish on duration. And we're really not optimistic or bullish on the more stressed or leveraged portions of the credit space. So we're sticking with that sweet spot. We'll call it 7-year A- rated to BBB+ rated investment grade credit.
Tom Tsouras of Strategas, a Baird company. Thank you so much for being with us. You pretty much agree with that it's sort of time to be cautious and collecting?
Yeah, and I think investment grade credit is going to do very well. And to the extent that we have any sort of valuation issues, the big drivers in investment grade credit, some of the larger issues, the Microsofts, the Apples of the world, even if something happened to their stock market value, the credit's just fine. So I think credit's going to behave very differently. It's going to be a good IG story. High yield may have gotten a little bit far, and we do like structured products. I think there's going to be some value in structured products.
And I know that you're not alone. There have been others who've been talking up structured products as well. Meanwhile, the consumers do keep spending, and they spend to travel. And Bloomberg's Guy Johnson's been hearing all about it at the Victory Laps at the IATA annual meeting in Istanbul. Guy, what's your observation, your takeaway after a number of wonderful interviews that you've done with executives?
Okay. Lisa, this is a room full of bulls. The bulls are here. They are bulled up. They think that the outlook for their airlines is absolutely fantastic. Bear Air has decided not to attend for probably good reason. So, yeah, the industry is super optimistic right now. They see the consumer still spending. They still see the kind of the revenge travel story as being strong. Yes, the business travel story is not coming back as strongly as maybe they would have hoped for, but premium leisure is delivering right now. The thing is, though, their visibility is probably 6 months out, kind of maybe 9 months out tops. Basically, they can see what's happening this summer. After that, things get a little bit more cautious. So there is a kind of, there's a strong kind of cyclical element to what is happening here, and they are kind of under the surface a little bit cautious about that. But what they do say, Lisa, is that this is still a heavily supply-constrained market. Can't get the airplanes, can't get the engines, can't get the staff, can't get the FAA to work. All of these sort of things are happening, and basically what that might do is keep the downturn the sort of the gradient on the downturn to be a little smoother. So we're kind of on the upturn right now, but we can get into the downturn. All that supply constraint is going to mean that maybe the glide path is a little shallower and a little more manageable for these airlines to cope with.
Guy Johnson of Bloomberg, thank you so much. And we will be catching up with you and seeing some of the interviews that you do throughout the remainder of the day. I do wonder, Peter, how much we can get some sort of recession, some sort of downturn with people still willing to spend double the prices in some cases even more, to just fly to some of the routine locations.
You know, I think travel is going to continue to do well. I think we had this shock on the good side 2 years ago, a year and a half ago, where everyone overbought on the good side. But I think people really, post-COVID, realized they want to go see family and friends more. You know, the quote-unquote bucket list all of a sudden became much more realistic. Like, wow, life is short, or it can be short. So I think people have a very different view towards travel, and especially the elderly. I think the elderly travel is going to be a really interesting part, where maybe they used to see their kids one holiday a year, now they're going to see two, or they fly their family to get together. So I think you continue to see that, and that's going to replace goods over time.
At what point, though, is the hassle, the sort of bother of the experience enough to say, actually, I think I'm fine at home? I'm serious.
You know, I would say, certainly in my own life, if it's a less than 4.5 hour drive, I now drive, just because it's much easier than trying to make it to the big airport, go through. But having said that, we'll travel, and I think we're doing a lot more business travel. Business travel is really, we've been pretty adamant about getting on the road, seeing our clients at Academy, and now clients want to see us more, so it's been fun. I enjoy it. It's great. It is a little bit hectic, but there's nothing that replaces meeting someone in person, talking and doing business that way. So I think that's going to resurge.
Do you enjoy flying?
I actually do.
Really? Do you have status? Is that why?
That might be why.
Yeah.
So there was one day that I had a horrible flight because I did Bloomberg TV the day after the Supermax crashed, and that was not a good day to fly.
Oof. Well, hopefully you'll have better experiences. Coming up, we get the other side with Tony Capuano, President and CEO of Marriott, on where people stay when they go on those trips. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The Treasury will kick off a borrowing spree today that some Wall Street estimates could top $1 trillion by the end of the third quarter. But analysts say the replenishing process could have unwanted consequences. Bank of America has estimated the debt insurance wave could have the same economic impact as a quarter-point interest rate hike by the Federal Reserve. Wall Street banks may be forced to boost capital reserves by 20% after the collapse of smaller regional lenders this year. That's according to the Wall Street Journal, which says the revised requirements may be proposed as early as this month. They expected to apply to lenders with at least $100 billion in assets. Airbus says the wide-body aircraft market is set to experience lengthy wait times because airlines are rapidly stocking up on long-haul jets. Airbus Chief Commercial Officer Christian Schurer spoke with Bloomberg's Guy Johnson from the IATA conference in Istanbul.
We're still in an area of turbulence. You never know where the issue is going to come from. There seems to be, and I say this very carefully, Guy, a tendency towards stabilization, but there is still crystallization in some areas of the supply chain. Engines would be one of them, of issues that are holding us back.
Airlines seeking to capitalize on the surge in travel are snapping up planes out of fear of being relegated to the end of the line. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot. You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Demand is sustainable and is going to continue. We see just a structurally higher level, particularly of leisure demand. You know, and a couple of reasons for that. One, hybrid work makes every weekend a holiday, gives people more time. If you're working in the office 3 days a week, you have more time to travel. But I also think coming out of COVID, spending 2 years on lockdown, people will no longer take for granted their ability to travel and experience.
Executives in the travel and leisure experience sector have been incredibly happy recently. That was Scott Kirby, United Airlines CEO, speaking with Guy Johnson over in Istanbul at the IATA general meeting. Everyone is a bull there. Also, everyone is a bull when you look beyond at the other related industries, including lodging. With me today is Peter Scheer of Academy Securities. Tom and John both off today. We were just talking about how you've been traveling a lot more and that people want to see you. That hasn't faded, has it?
No, not at all. So I think I'm traveling for 2 or 3 days a week for the next 4 to 5 weeks, and I like that. We go to see clients. Some's by train, some's driving, definitely flying, but we're out on the road, and I love it. Clients like it.
And basically, the person sitting next to you is just starting to smile bigger and bigger as you speak, saying, all right, this is what I like to hear. It's Tony Capuano, President and CEO of Marriott International. Things have been pretty upbeat. Does it continue, or does it sort of see an end date? Do people start pushing back against the cost?
I don't think so. I mean, what we've really seen the last couple of years is the resilience of travel, and we've seen it across segments and across borders. When we reported earnings at the end of the first quarter, we saw recovery across every segment. Of course, leisure continued to be strong. It was the leisure segment that brought us out of the pandemic. But group has been remarkably strong. In fact, when we look at the remaining 3 quarters of the year, we're up 26% year over year in group revenue. And business transient, many had predicted sort of the demise of business travel, but you made the point. Increasingly, folks are recognizing or reminding themselves of the power of getting in front of their clients, the importance of immersing new employees in their company culture, and as a result, we're seeing steady quarter-over-quarter improvement in business transient demand as well.
Is it everywhere for business, or are places like, say, San Francisco not seeing any kind of revival because of some of the outflow there?
Well, certainly markets like San Francisco are seeing slower recovery, but even there, I was listening during the break to Scott Kirby's comments. This phenomenon of blended trip purpose, I think, serves markets like San Francisco really well. This idea that through the pandemic, more and more travelers learned they can work from almost anywhere. Where we really saw this in the data is we look at recovery by day of the week. And what was remarkable is the 2 days of the week that recovered most rapidly were Sunday and Thursday, which pre-pandemic were really shoulder days. And what that tells us is with increasing frequency is business and group travelers are tacking on a couple leisure days pre and or post trip. And that really has the potential to help markets, even like San Francisco, which have some leisure appeal.
Peter, I see you nodding. You do that too?
Yeah, I think that makes perfect sense. I mean, I try not to, quote unquote, take many days off because you can work from your hotel room for an hour or two. We've done some Bloomberg interviews from hotel rooms when on the road. So you can do a lot, I think, exactly. You set up and you get these extended stays. And especially with the air travel, as you pointed out earlier, sometimes is a bit painful. It's much easier if you're going to go somewhere for 4 nights instead of just 2 nights or these day trips. So we try and do as much of that. I think it makes perfect sense. And that was interesting about the Sundays and Thursdays.
Well, but how much are you able to increase pricing then, based on the cost all in of traveling, which has gotten incredibly
high?
I
mean, compression drives pricing. And so what we see is in leisure destinations and some of the urban destinations that have a strong leisure orientation, like New York, we see a lot of compression. And as a result of that compression, we see strong pricing power. In a market like a Chicago or a San Francisco, where there's less compression, the pricing power is not as strong.
Are there markets that you're seeing expand much more dramatically? I know that we were talking about, for example, in Florida, how much hotel prices, and I know from experience that when I've tried to go visit family down there, it's a new experience when it comes to the cost of it. I'm wondering, though, is that continuing, or are you starting to see leveling off there?
You're seeing a bit of leveling off, but to the benefit of some of the international destinations. So just this morning, I was reading some statistics. If you look at outbound U.S. to Europe airline bookings for the summer, they're up nearly 50% year over year. And what that suggests is a lot of U.S. travelers who might have gone to destinations like South Florida or Southern California last summer, with increasing frequency, they're going to France and Italy and Greece. And so that's maybe eliminating a little of that compression pressure in South Florida, which will moderate pricing a bit.
How much are you trying to cater to the high end, which has been perhaps recovering even more?
So luxury has been exceedingly strong, but we have a portfolio of 31 brands across multiple price tiers and price points. So in the luxury tier, we continue to see pretty strong pricing power. But that's just one tier that we operate in. In fact, just last month, we acquired a brand called City Express, which signaled our entry into mid-scale for the first time, which is now the lowest price tier that we operate in.
Peter, I'm wondering from your perspective, if you've been seeing a drop-off with respect to the housekeeping, some of the other amenities around the experience of staying.
I have not, actually. I've really enjoyed it. I think we'll continue. I had a great trip down in Argentina. We did stay at one of your hotels as well as other places.
Oh, man. Did you, pay him off before coming in?
What does strike me, and we've been talking about, is are you seeing resurgence in Asia travel, too, or travel to Asia? That's something I've been hearing a little bit about.
Yeah, we are. And you almost have to look at it, China and the balance of Asia. Mainland China is fully recovered. But again, driven largely by domestic Chinese travel. International airline seats into mainland China are only about 40% recovered to where they were pre-pandemic. But the balance of Asia Pacific, particularly markets like Japan, Thailand, are booming right now. In fact, I was looking at some statistics. Somebody asked me a question about what are the most popular summer destinations. And the list that I looked at, some of the destinations you would expect, Italy, France, Greece, but Japan was in the top 5.
Are there any markets you're getting out of?
No, well, we suspended all our operations in Russia a couple of years ago.
Okay.
But other than extreme circumstances like that, no. We operate in 138 countries today, and in our 500,000 room pipeline, there are another 20 new countries.
To build on Peter's question, there is this issue of doing business in China, and we talk to every executive about how complicated that is as an American company going into the biggest rival right now economically. How much can you operate freely there? How much conviction do you have in the fact that the Chinese Communist Party will allow you to do your business?
So our business model, I think, serves us well there. We have 8,500 hotels globally. We only own 20 of those physical assets. So our business model is one of principally managing and franchising hotels. Of the roughly 500 hotels we have in China today, almost the entirety of that portfolio is owned by Chinese companies. And so I think that serves us well, even against the backdrop of some of the complexities of doing business.
Before we let you go, how much longer can this trend of YOLO and let's travel around the world really last?
I don't see it ending anytime soon. I think there was pre-pandemic a shift away from consumption of hard goods towards investment and experiences. And if anything, the pandemic served as an accelerant and caused that trend to spread across generations.
Tony Capuano of Marriott, thank you so much for being with us.
My pleasure.
We really appreciate it.
Great to be back.
And Peter, I will say that this is something that I've experienced. I don't know about for you with your children, but my children are much more focused on traveling than they are physical goods as well. I will just say, I mean, maybe it's just, them, but.
Yeah, my daughter's just graduated. She's actually headed to Tokyo on Wednesday, so she's following exactly what you're saying, I guess, right?
Well, it's going to be interesting to see whether this does continue and how much longer it can continue given the discretionary spending in the different tiers. This was great. Thank you. Thank you so much for being with us, Pete.
Thanks very much for having me. It was fun.
Is there anything that you're looking for this week that sort of stands out?
I think some rest. This was very tiring for an hour. But I think I'm going to be really focused on the data this week and see if we can get a story of where the economy's headed and whether this recession's really been pushed off or whether there's more negative headlines out there.
In this quiet period where we understand that Jay Powell is at a Grateful Dead concert, or was last night, and the Grateful Dead and company are very happy, saying by day he is the Federal Reserve Chair, by night he is a deadhead. Coming up next, Laura Rame, Chief U.S. Economist at FS Investments, will be joining us here on the hot seat. Where John and Tom are both off today. Right now in markets, pretty much range bound, pretty quiet, a little bit lower when it comes to the NASDAQ. Yields just a touch higher, but oil surging after Saudi Arabia.
Well, welcome back to another special Roland Garros update for Bloomberg TV and radio from Tennis Channel. I'm Erin Coscarelli. Novak Djokovic dominated Juan Pablo Barrios as he punched his ticket into the Elite Eight for the 14th straight year in Paris. The Serb hasn't dropped a set so far at this year's clay court slam, and he is now just one win away from a blockbuster matchup against the Spanish wonder kid Carlos Alcaraz in the semifinals. I'm Erin Coscarelli.
So you've built a successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From business's most influential and instrumental.
America's economy needs a diversity of institutions.
That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
recessions are having the intended effect.
I don't think the consumer's on the edge of recession. I think that we're definitely seeing weak spots.
The disconnect here is that you're not really seeing the slowing in the labor market.
Monetary policy is going to tighten around the world. But to me, the global recovery story is really a 2024 story.
My guess is this will be consistent with a skip, but one never knows.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's ISM Services Monday. It is also a Monday where John and Tom are both off. Welcome back. Good morning. This is Bloomberg Surveillance live on Bloomberg Television and radio. John and Tom, as I said, are both off today. Whether they're together, I don't know. I was looking at the Formula One schedule. It doesn't look consistent with their absence. Neither does, frankly, the Spurs, or the Tots, as Tom would call them. With me, though, I am so glad to say for the hour is Laura Rame, Chief U.S. Economist for FS Investments. As we look for the quiet week for the Fed, but not so quiet when it comes to the data. What are you looking for in terms of some ratification of whether it's a recession or whether it's a soft landing? It seems like there's nothing in between.
Yeah. One of the things that's been extraordinary is that the economic data have really been coming in much stronger than expected. And there's been one outlier of that, which are these surveys. And actually, one of my favorite, the Bloomberg Surprise Index, is at an 18-month high. And so it's going to be interesting today with services ISM coming out, because if there's a downside surprise, I think we need to be mindful of the fact that the so-called hard data, which really tie back to tax receipts or payroll taxes, are really still looking strong and continue to be upbeat.
Meanwhile, in the equity world, people are saying it's the beginning of a new bull market. People are getting excited about tech and then everything else right behind it. People are talking about how consumers will keep spending and keep traveling, with the travel executives all very happy with themselves. And I'm curious, from your vantage point, what could potentially torpedo this? I mean, as Pete was talking about, Peter Scheer, is good news just good news at this point, with the Fed pretty much on hold?
Yeah, I think the Fed being on hold just should not be confused with job done. And I think as we look forward to July, I know July 26th is a really long ways away. We need to get this June meeting out of the way first. But the data as it stands really point to continued Fed rate hikes. We had the debt ceiling, interrupting that. We had obviously the banking system in March, derail those Fed expectations. But it seems to me like we're kind of headed right back to the same Fed trajectory that we were at in March, which would imply a Fed funds rate of 5.5, if not more.
And you don't think that that's priced in, or at least absorbable in markets the way they are?
I think that we're still seeing this dichotomy. We're seeing the bond market sort of screaming at alarm bells for potential recession, but equities pricing in steady earnings and then an acceleration into 2024. The equity rally has been so concentrated. Everything's great when these sort of large cap stocks are pulling the whole thing higher. I think we have to be concerned if there is some sort of earnings correction priced in and it starts, sort of being the anchor that pulls the whole thing lower.
And Morgan Stanley's Andrew Sheets came out and said that he expects a 16% decline in earnings per share. So perhaps that's where you start to get some of the reassessment. Right now, you're seeing a bit of weakness led by the NASDAQ. Not a lot of drama, though. Let's be honest. This is a pretty slow morning when it comes to the S&P. You see unchanged. You see 0.2% decline in the NASDAQ. A bit of dollar strength. Euro weakness, 106.90. Yields marginally higher, but nowhere near the view that you're talking about, 5.5%, Laura. You're seeing over in the 2-year space about 4.5%, and in the 10-year space, 3.75%. Crude price is interesting, up 2.4% on the heels of the Saudi Arabia unilateral 1 million per month barrel cut, given the sense that they want prices higher.
Yeah.
They want a little bit more to shake out some of the shorts. What do you make of that?
Well, I think they're pushing against this concern about global growth slowing. And I think China in particular, clear evidence that their rebound is not going to be this explosive V-shaped recovery, but is sort of going to be a muddle with hopefully a positive slope. I think that is really tough to swim against.
And right now, I should say 1 million barrels a day.
Yeah.
And this is something that people are basically saying, okay, this could add to prices. but not that much.
Yeah, I mean, it's important that Saudi Arabia is falling on the sword, and I think keeping OPEC together, that is probably at this point the best defense, is sort of a unified defense. But like, you know, at the end of the day, if we're looking at some of these big industrial economies just not experiencing such a robust growth trajectory and growth concerns there, it's going to be hard to really maintain positive momentum in oil. I think we're looking at more at a floor around where it is.
And this is the reason perhaps you're not seeing as much enthusiasm in some of the equity stock space. Tomorrow we do have Andrew Sheets of Morgan Stanley. Today we are so lucky to have Vishy Tirapatur, U.S. fixed income research head over at Morgan Stanley. And one thing that people have been talking about today, the list of worries that they're sort of casting aside, is the net issuance of $1 trillion of T-bills following the resolution to the debt ceiling debacle, debate, whatever you want to call it. People are saying it's not that significant. It's priced in. Do you agree?
I disagree. I think this has the potential to be pretty significant. We are expecting between now and the end of the year 1.2 trillion of T-bill issuance. This needs to be absorbed in the system, and the natural buyers for absorbing this are the money market funds. The money market funds have currently parked a good chunk of cash at the reverse repo facility. They could take the money out of the reverse repo facility and buy the T-bills. But in order to do that, the T-bill, the rates or the yield that you would get on T-bills need to be comparably attractive to the reverse repo rate they're currently getting. And also, they need to have some sense that the future of monetary policy. If the talk of another hike or another 2 hikes, etc., is very much in the play, then they would be more reluctant to take the money out of the reverse repo facility and buy the T-bills. So we think that this easy, smooth transfer of money from the reverse repo into the T-bills is not going to be that smooth, and there is a risk that some of this is going to be a lot stickier, and a stickiness of the reverse repo means that money will have to come from elsewhere. We think that would potentially mean the reserves in the system, and that ultimately amounts to withdrawal of liquidity in the system, and that is certainly very much on top of my mind.
Yeah, Vishy, I think a question that continues to come up is this slow squeeze in lending standards and credit availability. And I think what I'm hearing you say is that really this is the plumbing that is going to just keep that trend moving. Do you expect this to really resolve over the next 1 or 2 quarters, or does this lay on top of the Fed, any potential Fed rate hikes? How does this move as we sort of look at the second half of the year?
I think this is, we have seen some, tightening of lending standards that was from, tightening of lending standards began late last year. And we saw, even coming into the Q1, we saw some tightening of lending standards. But I think that largely reflects the turmoil we saw in March, the incremental lending standard tightening that we saw in Q1 in the senior loan officer survey. That really reflects the turmoil in March and really doesn't capture the incremental regulatory change that is going to be coming to the banks, particularly regional banks. So the effect of the tighter monetary policy, the much discussed lagged effect of the tighter monetary policy, layer on top of this high Fed fund, the front end of the curve, because of this T-bill issuance and the need to be competitive with the reverse repo. It hits at the same time that the liquidity pressures remain in the regional banking system. So you can look at the continued reliance on the bank term funding program. Yeah. I think we are at $97 billion now. So this continued reliance means the tension is there, and the front end rates need to be high, and the effect of all the future regulatory capital change that's going to come will weigh in on the ability of regional banks to be continued robust lenders.
Some people might be listening to this and hearing, wah, 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 reverse repo, wah, 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 wah. Are we going to have a crisis, right? I mean, that's sort of like the sort of polls right now of the discussion. When you take a look at money that might be flowing out of reserves at the banks or just in other assets in general, going into T-bills, does this mean real risk aversion that's going to lead to some sort of massive decline in either credit valuations or equity valuations that perhaps hasn't been accounted for?
I think so. I think liquidity has been has really been a big support mechanism to the markets, and withdrawal of liquidity through this process has the potential to be significantly negative to risk markets at large.
Vishy Turbatur of Morgan Stanley, thank you so much. And that's sort of one of the questions that we've been asking all morning. What's your view?
Yeah, to me, this is going to be one of the defining features of the second half of the year because the data today looks strong. Some of the forward-looking indicators are more downbeat, and you overlay credit conditions on top of that, and that is the difference between a slowing economy and actually tipping into some kind of contraction. Is it going to be a slow squeeze of credit conditions? Hopefully not a crunch. That's what I think we just heard. Thank goodness. But I think a slow squeeze matters, and it really unwinds the massive liquidity that we've all gotten complacent with.
Adding to that, the Wall Street Journal this morning reporting that regulators are thinking about increasing capital requirements of the biggest banks by 20% in response to some of the turmoil that we saw in March at regionals, and yet the large banks are the ones that have the wherewithal to actually increase capital reserves. How much does that also add to this potential constraint on credit?
I think it absolutely adds to it. We have to ask ourselves if they're not putting some of that in place preemptively. And I think we may very well be seeing that. You know, the Dallas Fed has a good shorter term indicator of lending. I think it's something we're all watching very closely because the senior loan officer survey is only a quarterly release. This is something that we'd love to get more timely information on. Hopefully the Fed will be better at releasing that. But to me, this is really going to be where the rubber meets the road of monetary policy and the economy over the next half of the year.
And this is actually exactly what people were saying after JP Morgan put out their earnings results, that they're actually already building some of this capital in excess. So even if it doesn't get passed right away, the implications for the economy could be more current and more imminently felt. Coming up at 8:30 a.m., we're going to speak with Michael Gapin of Bank of America. It's economist versus economist here on Bloomberg Surveillance as we chart toward a Fed-free week ahead of the meeting next week. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Russia and Ukraine are reporting widespread fighting along the war's front lines as anticipation mounts for a long-planned Ukrainian counteroffensive. Moscow says its forces defeated a large-scale Ukrainian attack in the Donetsk region on Sunday. Ukraine says it repelled all Russian attacks. Ukraine is gearing up to try and reclaim Russian-occupied regions of the country, backed by billions in weapons supplied by Kyiv's U.S. and European allies. Prime Minister Rishi Sunak is defending his efforts to curb migration. Speaking in southern England today, Sunak said, quote, "Our plan is working," citing a 20% decline in small boat crossings between January and May this year compared to 2022. But critics say adverse weather is the main reason behind the decline. Sunak's government has been trying to make the UK a less attractive destination for people arriving via routes that are considered to be illegal. Morgan Stanley strategists anticipate a sudden pullback in corporate earnings will slam the brakes on a U.S. equity rally. Now, that's a call at odds with Wall Street estimates. The bank strategists predict earnings per share for the S&P 500 are set to drop 16% this year. That's one of the most bearish predictions among those tracked by Bloomberg and contrasts with bullish forecasts from the likes of Goldman Sachs, which anticipates mild growth. UBS expects to wrap up its acquisition of Credit Suisse as soon as next week. Credit Suisse shares will be delisted from the New York Stock Exchange on June 12th and the Swiss Stock Exchange on June 13th. UBS agreed to take over Credit Suisse this year in an emergency sale backed by the Swiss government amid fears that the smaller troubled competitor was headed for bankruptcy. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo. This is Bloomberg.
York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep rate World Cup. This is a 3.
As the economic picture down.
The OK is getting ready to make a decision.
Tuesday, following the worst ever year on record, bonds are back. Bloomberg is live from PIMCO headquarters in Newport Beach, California, sitting down for exclusive interviews with CEO Manny Roman, income fund manager Dan Iveson, and more as the biggest names in fixed income reveal their bond market forecasts. It's a special episode of Bloomberg, The Open, with Jonathan Farrow at 9 a.m. Eastern, only on Bloomberg Television.
The consumer credit quality in our industry is very strong. The disruption caused the capacity to lend to come down, which again is as they pulled money out of the banking system and into the Federal Reserve as cash or into the overnight repo facility, and deposits have come down, part of the monetary tightening. There's less engine in the engine room to lend, and then so that causes banks to be more careful when they lend and who they lend to and how much they lend, and so that's tightened credit standards pretty dramatically.
That was Brian Moynihan speaking on CBS over the weekend. Bank of America CEO talking about the imminent increase in tightness in credit conditions, and we're hearing about this increasingly, and yet in the latest senior loan officer opinion survey, we didn't really see it. Of course, it has been on a lag. I'm Lisa Abramowitz. John and Thomas, you've noticed, are not here. They evidently are having a wonderful long weekend and possibly at some sort of sporting event together, and they'll come back talking all about it. I can't wait. Hopefully they will bring pictures. Luckily, Laura Rame here alongside me of FS Investments, and we've been talking about that tightening in credit conditions and how much we haven't yet seen. How do you track that?
So the Dallas Fed is issued a weekly survey of lending, which is really useful. And I think more broadly, you look at all of the ways that it hits the consumer. You're looking at the mortgage applications. You're looking at car sales. I think something that's really interesting and that really differentiates this cycle from the mid-2000s is the fact that we have a pent-up demand for cars right now. We have a low supply of housing. There are these things that are offsetting the fact that higher interest rates are clearly having a cyclical headwind, to some of these demands.
It's been really confusing. I will be honest. It has been one of the more confusing times to parse through the economic data. And I know that Shonali Bossack has been doing it as well and looking and trying to understand the banking impulse of Bloomberg, our correspondent for the financial industry. We also have this added suddenly 20% increase in capital charge that the Wall Street Journal is reporting. How much, when you talk to executives at big banks, are they talking increasingly like Brian Moynihan just then? This is going to be a dramatic shift that's going to be happening over a period of time.
There are delayed effects, but then there's also that reality that there's a lot of uncertainty about what the consumer looks like by the end of the year. Even Brian Moynihan, who tends to be the more optimistic of the bank CEOs, has said that spending is really starting to slow. And you have JP Morgan also saying over at the investment bank here that conditions are tightening, but you're not seeing demand up to a significant degree. When the coffers for the consumers start to dry up, then does that demand tick up for credit card revolve, for other kind of credit products here? So I think you are not seeing the worst of it. Of course, that there's that delayed effect. That capital charge, Lisa, sticker shock. 20% higher of a capital charge here. You have to consider here that the big banks are not the ones that failed recently. It's the smaller ones. And you have to start thinking about whether you start to constrain the big banks' capacity. The big banks are also lenders to the small banks. I think there's about 4,000 that JP Morgan banks alone. Citigroup banks a lot of minority depository institutions as well. So when you think about that credit contraction and the ripple effects of it that come from tighter regulations, that's now a years-long process.
I think something we're all watching too is consumer delinquencies, which have moved up, but really are not at levels that we associate with some kind of broader economic stress. And of course, with the unemployment rate so low, it's we still have a lot of income generation. How are folks like Moynihan and other bank CEOs thinking about delinquencies?
They keep on thinking about it by means of normalization. But I think even for the big banks, you have to think about profitability into next year and not just how much money they're losing. Think about Amex. I think Amex was a big shocker in the last cycle, in the last quarter here, because they had just provisioned so much for loan losses, and they tend to bank wealthier consumers. And so what does that ripple effect look like as provisioning for potential future rainy day starts to go up? You have pressure on profitability at a time where other business lines are also. Look at Goldman. They just told you that they're going to have a pretty steep drop off in trading revenue, and so you don't have that ballast to kind of support that kind of pressure on income on the trading side.
And I was actually going to go to Goldman and John Waldron, who's going to be speaking at the Bloomberg Invest Conference this week. He had a different tone last week, and a lot of people were noticing that he was talking about how the clients of the bank were having a markedly different approach than they were, say, 6 months ago. And this flies in the face of the whole new bull market. Everything is going well, and speaks to something slightly different. Is this a Goldman Sachs problem, or is this a problem that you're hearing more broadly?
It's definitely a problem we're hearing more broadly, particularly if you have large corporate clients or if you have a large trading desk, which again, when you look at the stress test, another kind of shocking thing here is the trading desks are actually the ones that will be facing the higher capital requirements according to this journal report. What does that tell you? Is the Fed concerned about future market conditions and future liquidity? It's not like the trading desks lose a ton of money every year. These are not pre-2008 trading desks. They've cleaned up a lot. But at the same time, you have a lot of folks that are worried about leverage underneath the system. You had the LDI crisis, you had the banking blowups, and the big worry here is what's the next shoe to drop.
Well, I will say that a lot of people are getting sick of worrying. I'm not saying myself as one of them, but there is this sort of feeling of, okay, we've been worrying about this, we've been worrying about this, we've been worrying about this, and all of a sudden the returns have passed us by and we've got egg on our face. And at a certain point, Laura, you have to wonder, perhaps we're looking at it wrong. One thing that struck me in the first quarter was a lot of companies did not invest in their businesses, and actually the demand outstripped what they were able to invest in. How much is that going to be brought forward? And you're going to see that business investment, that final return to actual activity, as the consumer is held in there.
Yeah, this is another place where I think we're facing clearly some cyclical headwinds, higher interest rates, but there's structural tailwinds. I mean, we still have an infrastructure package that's working its way down to the company level. We still have some big secular shifts, EV, manufacturing, that's still, I think, ramping up. So, and I think Chat GPT, I think AI is another place where we see from these tech companies that are supposedly cutting costs, a lot of talk about needing to invest in this new technology. So I see some secular tailwinds, even though I think right now higher interest rates and some economic uncertainty are biting.
Have your daughters been using ChatGPT a lot? My sons do.
Not yet, but I have to say in the office we're certainly playing around with it. I mean,
for what?
Well, I think you want to get to know it. I think we're just still trying to work it into just finding out how it works, asking it questions. It is an extraordinary technology, but it's still so new.
My kids use it for grading their papers, for helping write said papers, but not that much.
They give themselves a grade before they get the grade from the professor.
They put in parameters, and then they get a sense of what they would get so that they are aware, so that they can move ahead of that and then correct things. Anyway, I digress. I am curious from your vantage point, Shonali, how much, as the bank executives talk about layoffs, et cetera, we've been talking also about return to work and return to office and return to travel. What's the pressure like there to actually get back, especially at a time when a lot of people who used to go to tech are now shifting back to Wall Street?
I heard this fascinating stat from a real estate manager the other day. The idea here that businesses are not necessarily spending a lot less on real estate. They are just amping up a smaller amount of space to get people to come back. There are a lot of frustrations embedded in that. We've talked about hoteling on this show, this idea that people have to sit at different desks at different times, but they have a cooler office space. That's a complicated calculus here. So to Laura's point here, you do have businesses still spending. albeit less in aggregate. They want people to come back and be as productive as possible, but they want less people because there's less activity. That's kind of the easy way to say what's happening right now. And they want them in the office.
Sonali Basak, thank you so much for being with us, as always. Laura, are you back in the office?
We are, but I have to say, we have the food, we have the exercise. I think it's increasingly their
job offer. We have the food, we have the exercise. So
anytime you want to come.
Carry on.
But I think the important point is it can't just be the same old office space, and it still is a dance. Regionally, you look in different areas. I think the Northeast is going to be one of the places that it's a little bit harder to get people back to work. But you look in the Sunbelt states, I feel like people have been back since 3 months into the pandemic.
With business travel, this is a sensitive question. Are people traveling first class, or are they traveling more economy?
Well, I know for me, it's economy, and it's a lot of business travel. So there is just, at the end of the day, this real demand to get people face to face.
It's a sore spot that I keep hearing about, that a lot of the guests, they're flying economy, and they're saying, it can be a little physically uncomfortable when you're traveling that many hours a day. Coming up, we have a conversation with Michael Gapin of Bank of America Securities as we head toward ISM Monday, and a quiet week for the Fed, but anything but when it comes to economic data. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Welcome back. This is a special edition of Bloomberg Surveillance with just Lisa Abramowitz, and Laura Rame and Tom and John are both off today. They will be back on Wednesday, but they will be off tomorrow as well. We do have a slew of data so far for this week, including ISM services data that comes out at 10 a.m. Right now in markets, you are seeing a bit of a softer tone, at least in the NASDAQ, although in S&P it's turned, I mean, that's basically flat. We are seeing a bit of dollar strength, euro weakness, 106.8. We're trying to figure out whether this has some directionality to it. Yields marginally higher, 5 basis points. It's been steady throughout the morning at 3.75% about, plus or minus. New York crude, this to me is really interesting. Crude valuations climbing to near session highs, 2.6% pop on the NYMEX after Saudi Arabia agreed to unilaterally cut 1 million barrels per day from their production, at least for 1 month. Heading into the week, ISM starting us out. Michael McKee with us here, Bloomberg International economics and policy correspondent. Mike, what are we expecting to really learn this week after a jobs figure on Friday that seems to have been somewhat forgotten?
Well, the ISM is the highlight of the week. It's about the only number that anybody's going to care about, maybe a little bit with jobless claims on Thursday. But the economy has been stronger than anybody expected. And so the ISM services is going to either refute that or underline it. And then we'll look at the underlying indexes within that, especially employment, to see if that matches up with what we've seen with other numbers where the service industries are still looking for a lot of people, and what that means for prices paid, because of course service is the largest component of the expense for service industries is labor, unlike the ISM manufacturing, where we saw a big drop in prices paid, but that's heavily influenced by raw materials, commodities. So we'll see if this confirms what the Fed is seeing, a stronger than expected economy. Don't know that it's going to make a big difference in terms of what their decision is going to be.
So here's how we're going to set up the next 10 minutes or so. Laura Rame, you're with me, and this is going to be a battle of the economists, and I can sit back because we have a table full of economists with us. But before we go into our next guest, I'm curious what the main issues of contention are. My sense is it's inflation, how sticky it is, how high the Fed can go, how significant the bank lending tightening will be, and how long consumers can keep spending, as though YOLO is really the remaining feeling of the day.
Yeah, and I'll add to that whether or not there's going to be a recession. I mean, you know, there has been a real, I think, you know, herd mentality among economists. I confess to being among them, simply because when the Fed raises rates, historically, we get a recession. I've been joking that you'd like to say that, you know, the horror movie ends a different way, but usually, you know, the 7th installment of Halloween ends the same way that the other 6 installments did. So, you know, we have the Fed aggressively raising rates. I've been in the camp that will eventually give us a recession, but I think that is one of the core disconnects. And you're seeing, I think, right now a real groundswell of hope that there's going to be a soft landing.
Hope that Halloween will end a different way. Yeah. The Fed, meanwhile, is in its blackout period ahead of the June 14th meeting. Bank of America's Michael Gapin weighing in on the Fed's path forward, writing, quote, "The May jobs report is a particularly difficult one for the Fed to parse. Coming out of the May meeting, we argued that the Fed was inclined to stay on hold in June and the onus would be on the hawks to justify a hike. We think the May jobs report is just soft enough to justify a hold, but perhaps not just soft enough to justify staying on hold for a long period of time." Michael Gapin, U.S. economist at Bank of America Securities, joins the table of economists here. So can you give us a sense of what the threshold is now for them to stay on hold?
Well, I think you need to see some material softening in the data. I think they've certainly communicated they'd prefer to skip, and yes, I think that there was enough mixed messages in the employment report where they could do that if they want to. Personally, I think the establishment report still gives the better signal. There's probably some sampling error in that household survey. But there's resilience in the labor market, as you mentioned, the resilience in the consumer, as you mentioned, and some stickiness in inflation. And if the risk backdrop is diminishing and bank stress is more or less in stasis, then their communication should shift back in the direction of pushing the policy rate higher. That's probably the debate that they will be having next week.
And I know that Laura's going to jump in here with a number of questions, but I'm curious how high they can go, whether the market is accurately reflecting that perhaps it's another quarter basis point hike, but it's not going to be that significant. It's not going to materially change the outlook in terms of the benchmark for the Fed.
Well, I do think back in March, before we had the bank stress pop up, I do think that they were going to guide markets to 5.4 or 5.6 on the terminal. That's probably the direction we're going back to. Could we get to 6 or above? Yeah, it's possible, but I think somewhere between here and say 5.75 to 6 will be sufficiently restrictive. Certainly, we are seeing evidence that past hikes are working on at least parts of the economy. And so I'm not convinced that they need to kind of really ramp things back up. But yes, we're essentially saying if some of the bank stress and other issues have dissipated, then the Fed should fill that gap. 2 or 3 months ago, they thought that gap would be somewhere around 5.5, maybe a little above. I think that still holds.
I think something that has really been unique about this cycle clearly is inflation, and the disinflationary process is happening, but I like to say it's a lot easier to get from 9% down to 5% than from 5% back to 2%.
Right.
And I think one of the things that really has come out of the recent tsunami of Fed speak is markets pricing out the rate cuts. And this is really looking around the corner right now. But when you think about the Fed rate hike cycle kind of winding down clearly as it ends, I feel like markets rush to price in the next leg down in the Fed funds rate. To me, this is looking like it would be a very different process. It wouldn't be the elevator down that they usually take with rates.
Correct,
Do you have any thoughts about how that could evolve?
Well, I think that's right. So the balance, Lisa, between the how high and the how long, I think, both of that is in this discussion. And I think you're right that maybe markets didn't baseline expect cuts this year, but in distributions of outcomes, you had to put a lot more weight on that hard landing. And if the external risk backdrop is improving, those cuts come out as a result. So yes, I think if you're not, if they're looking to kind of fine tune where the policy stance is, some of that is the how long. And I think markets have done it correctly in the sense of first you price out those cuts, we'll debate on how high things go. So the cycle could be a little different one where you're right that getting inflation down to the mid 4s has been relatively easy. They've gotten help from other spaces. How we get that down to 2 is still in front of us.
So do you think the good news is still good news, as Peter Shih was saying?
No, I think good news is back to being bad news. Because good news, if you include the risk backdrop, meaning less risk, then you should, in theory, get more Fed hikes. So I think we're back to the good news is bad news world.
Laura?
How much do you, there's been a lot made about, obviously, corporate margins have been relatively healthy throughout this period, and they're starting to narrow somewhat. There's been talk that is now one of the factors that's adding to inflation, the fact that companies are being a little bit, greedy about not wanting to, clearly, as would make sense for their own shareholder value, not wanting to give up that margin. How much is that now a driver of inflation, or is it still a reaction to the strong economy?
I think it's fair to say it's both. And what I would say is what has surprised us most about the inflation forecast is how little goods prices have come down. I think we were all kind of on the shelter story, and that pass-through seems to be happening as we would have expected. But to me, the big shock is you have these big durables items, new cars, used cars, household appliances, and so forth. They've been basically flat. And I think that's what you're seeing is that, margins have been getting squeezed and then they got widened out, and I think corporations are deciding, well, what is the elasticity of a price cut at this point in time? So I think the strong economy has meant goods prices have not come down as much as we had expected. Conversely, to open up room for goods prices to come down and for inflation to get back to 2, you do have to moderate demand. And that's why I think good news is bad news.
I have a question for both of you guys. Since you both have traders at your offices, the anecdotal information I get is that, Fed funds futures have been very volatile. They've been up and down about cuts and things like that. But traders have not. The expectation on the desks is that the Fed is going to stay high and maybe even raise rates again. So we're getting conflicting signals from the trading desks and from the Fed funds futures.
I think that's fair. I think, there's some people who play that game more than others, and some have different time horizons. I'd say the majority of investors that I meet with, so let's say 2 out of 3, are on board with the higher for longer and likely no cuts this year out of the Fed. However, there's a group of investors I meet with who are very concerned about bank stress and see that as being more material, and people like me are too complacent about it. And they say, well, the lags are going to hit later this year, and the game is up in effect, and we'll know it when we see it. But I would say, yes, there are more than not saying higher for longer seems to be where we're going.
I would say the same thing. I think that on our desk, there's, a mix that reflects the futures curve. And there's a vocal group that is perhaps smaller in number that really feels like the Fed's raising rates. They're going to break something. We are going to see yields come down very sharply should the economy slow. And I think that's one of the reasons why we have this sort of fight in the sort of 1 year ahead Fed rate expectations. But a lot of us are still in kind of, I think, a camp that they're not going to have the room for that.
In the past 3 weeks, it seems like there has been a shift in tone, where a soft landing has suddenly become more likely than it had been. It's back.
Right.
How long is it going to stay back, Mike?
Until we get guidance that the funds rate's going closer to 6.
Okay, so you think the Fed's going to break it? You think that's
well, no, I think the soft landing can't be ruled out. I don't think it's ever been able to been ruled out entirely. I just think, as you mentioned in the lead-in, history suggests it's more likely than not when the Fed moves this quickly into counter inflation, you do have to pay a price at some point. So I think we're all in the, okay, that outcome's more likely than not. But it's a very different cycle, and I don't think we can entirely rule out that they kind of hit it just right. So it is back on the table at the moment because the risk backdrop has improved. Now we'll see about the other direction.
I feel like it always looks like a soft landing until all of a sudden you're faced down in a recession.
I mean, we're in a recession forecast, so I can't. I'm not going to talk away from what the view is
from your point of view.
Yeah, but I just So I still think in the end it's more likely than not we'll have to pay some price to bring inflation down. And given what I said about goods prices being firm and the consumer being resilient, you have to lean against that.
Will Halloween have
a recession is when your neighbor loses his jobs. A depression is when you lose your job.
That's right.
And I guess a soft landing is when bonuses are cut on Wall Street.
Michael Gapin of Bank of America Securities, thank you so much for being with us. You get a couple of economists around a table and things get a little bit perhaps more gloomy. Coming up next, we'll take a look at what's going on over in the tech sphere. This is Bloomberg.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. The Treasury will kick off a borrowing spree today that some Wall Street estimates could top $1 trillion by the end of the third quarter. But analysts say the replenishing process could have unwanted consequences. Bank of America has estimated the debt issuance wave could have the same economic impact as a quarter-point interest rate hike by the Federal Reserve. Wall Street banks may be forced to boost capital reserves by 20% after the collapse of smaller regional lenders this year. That's according to the Wall Street Journal, which says the revised requirements may be proposed as early as this month. Now, they are expected to apply to lenders with at least $100 billion in assets. Apple shares are set to hit an all-time high. It comes ahead of the company's Worldwide Developers Conference today, where it's set to introduce a mixed reality headset. Now, it's Apple's most significant product launch event in nearly a decade. At the current price, Apple is poised to add $16.5 billion of market cap, putting it even closer to a historic $3 trillion valuation. And oil advanced to open the week after Saudi Arabia said it will make an extra 1 million barrel a day oil supply cut in July. The announcement came after a tense OPEC Plus meeting over the weekend. The move takes its production to the lowest level for several years following a slide in prices. And Prince Harry's phone hacking trial against the publisher of the Daily Mirror kicked off today without him present in court. His attorney says he's taken a flight from Los Angeles on Sunday after his daughter's birthday. Well, the judge says he was surprised, noting he had directed Harry to be in court for that first day of his case. Now, this is the first of the prince's lawsuits against the media to go to trial. I'm Lisa Mateo, and this is Bloomberg.
In big big ideas. We show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
I view Apple right now in some of the parts. I could argue that AI adds another $30 to $40 per share to the Apple story.
What's Apple doing with AI? What's that about?
I think what Cook's going to talk about is AI could be really another foundation, another monetization of the Cupertino growth story.
That was Dan Ives of Wedbush Securities when he joined us on May 26. What we're seeing today, Apple shares rising toward record highs ahead of the Worldwide Developers Conference. I always think that it's going to be what would Apple do as sort of WWAD, but you know, it is this. Right now, we're seeing Apple shares up more than 1%, 182.84 in pre-market trading. Joining me today is Laura Rame of FS Investments for the 8 a.m. hour Eastern Time. Tom and John both are off today. They're going to be off tomorrow, but they will be back on Wednesday, and it will be all together. I am curious, though, how much this Apple and this sort of tech dynamism can continue with AI really charting a new course for potential growth in the sector.
Yeah, absolutely. And I mean, tech has been in the crosshairs in so many stories so far this year. Tech layoffs, I think, really causing broader concern about the economy. I think, you know, these companies recently doing more cost cutting, it kind of shows that they're maybe moving away from growth at any price to needing to behave a little bit more after 20 years or 25 years, a little bit more like traditional large cap companies. And then finally, you know, what is the impact of AI going to be? To me, I look at these calls and I hear more spending on investment, not less. But I think that's a huge debate that I'm sure will be raging this
Let's get to that with one of the top reporters in the tech sphere ever, Mark Gurman of Bloomberg, who always is breaking scoops on Apple and beyond, who's taking a look at what's going on in the Worldwide Developers Conference that Apple is holding. Want to start there. What are we expecting to hear with artificial intelligence?
Yeah, thank you so much both for having me. I'm not expecting any significant announcements today related to AI or artificial intelligence. I still do think we are about 1 to 2 years away from any significant new announcements on the AI front for Apple. Today is going to be all about mixed reality, the Mac, and software updates for the iPad, the iPhone, the Mac, and the Apple Watch. So not expecting any major AI initiatives, not entirely sure where that speculation came from for 2023.
Mixed reality. Let's talk about that. Is this going to be just another kind of metaverse play where people are going to talk about how this is going to be the new thing with gaming, et cetera, and yet people aren't going to necessarily go to the consoles and it'll be so quickly rendered obsolete by some new establishment that it won't ever take off?
Well, similar to the metaverse products, right? This is going to be a mixed reality headset that's going to have both AR and VR. The difference is that Apple's not focusing on these sort of social network based 3D worlds where they believe you'll interact exclusively with people through the headset and the online world there. This is going to be more of a communications, productivity, content consumption, and gaming device. This is something that Apple imagines could one day replace the iPhone, iPad, and even the Mac. Right, so they're doing it differently. The underlying technology is the same as some of these Quest headsets and other headsets where they really push the metaverse, but the functionality, the push is going to be essentially entirely different, more on the productivity side rather than the social networking side.
Is there any talk at the conference about production duplication, moving production out of China? I feel like that has been a huge place where Apple is one of the, bellwethers for production in China, and duplicating that supply chain or enhancing it. I'm interested how that discussion goes at this conference.
Oh, yeah, they're not going to talk about production or manufacturing or anything like that at this conference, right? These are consumer conferences. Apple never really discusses their manufacturing plans or anything regarding logistics or operations at these conferences. That's all very behind the scenes. I can tell you that the Macs, right, they're pushing more Mac production into places like Vietnam versus in China. But the mixed reality headset is something that actually will be produced in China. That's something that's a bit too complex to be, pushed offshore to other parts of South Asia.
But to build on this, right, this is sort of one of the bigger questions about how long they can continue to grow at this type of pace if they do get pushback from China. How much can they innovate their way beyond $3 trillion? They're almost there, and go for growth in a new innovation rather than services, rather than the iPhone, and just continuing to upgrade it.
Yeah, no, I truly do think that this mixed reality headset eventually could add a ton of money to the bottom line. I think this is going to be a revenue growth driver combined with new versions of the Apple Watch. I think that we all know the iPhone is pretty stagnant at this point, but the growth opportunity on wearables is extraordinarily strong. I don't think that's something that's going to come to fruition in the next year or two, but if we're talking 5 years and beyond, I think the wearable business could become a real big part of the overall Apple story. If you're not looking at services, the other cool area to consider would be a self-driving car. This is something that Apple continues to work on. That's the one area due to car price that could really double Apple revenue over time and really contribute to the growth metrics at Apple. That's something that's probably not going to come to market for at least 5 to 7 more years, but eventually that's going to come. It is still on the table. It is still being worked on. So I think the combination of the car and wearables does indicate a pretty good long-term growth story for the company. But again, long-term, this is not something that's going to move the needle in the next few years.
Well, and we just heard from Michael Gapin the fact that, goods prices really have not come down very much. And I think that continues to be a place where we're seeing companies really try to protect their margin. Are we continuing to push prices? I think, obviously the headset looks to be quite a solid investment from the consumer. The rest of their goods and wearables, are those going to continue to push price up as well, I would guess?
Yeah, so the Apple mixed reality headset is likely to come in around $3,000. It's going to be a very low margin product for Apple. It's something that has a lot of intense new technologies inside and a lot of very pricey development, right? And so that's something that Apple is going to have to price nearly at cost when you incorporate R&D, manufacturing, logistics, shipping, and packaging, in addition to the actual bill of materials. On the other wearable side, you're likely to see pricing of the Apple Watch continue to go up as they add new functionality. The Apple Watch Ultra has raised the ASP of the Apple Watch considerably, given they have the new $800 starting price for that pricier fitness-oriented model, right? You're likely to see more expensive versions of that hit the market as well, probably into 2025, new versions with bigger displays. They're developing their own in-house display technology to replace components made by Samsung and others. You're likely to see that drive up the cost as well. So you're likely to see some revenue growth just by the fact that ASPs are going up as well. In the near term, I'm not expecting them to sell more than 1 million units in the first 12 months of the Apple headset. So you're talking about, a $3 to $5 billion revenue contribution, which probably does not necessitate much growth. But over time, as they lower the price and escalate in terms of volume, I think it could add a considerable amount of new revenue to the company's bottom line.
Mark Gurman, thank you so much. Truly a clinic, and really wonderful to hear your point of view, especially given that it might cost $3,000. And I just keep wondering, Laura, how much, gamers on average can spend $3,000 for a new headset. I mean, if it's really neat, I imagine maybe some could spring for it.
It will not be on my children's birthday list this year.
I can guarantee you most parents are basically saying that right now, although this probably is not geared toward them, right? Because if it's only 1 million sales only, I should say, but considering the population, most parents are basically saying that right now, although this probably is not geared toward them, right? Because if it's only 1 million sales only, I should say, but considering the population, it is for a select group that can make that investment. And then over time, it can really change. This has been fun. Thank you so much for being with us.
Absolutely. I love the economist throwdown. That was great.
Exactly. Trying to understand. You get economists around a table and they talk about all the negativity about how the world is like Halloween episode and it's probably not going to end in a different way.
Well, things look good for now. I think that's the really important point. And, mild recession. I want to reiterate that.
Mild recession. That seems to be the view. Coming up on The Open, we're carrying forward the conversation with Matt Miskin of John Hancock, Krishna Mamani of Lafayette College, Joanne Feeney of Advisors Capital Management, and Tom Forte of D.A. Davidson. And tomorrow on Surveillance, John and Tom still are going to ditch me. I'll be joined by 3 more great guests. Julian Emanuel, Greg Peters of PGM Fixed Income, and Neil Dutta of Renaissance Macro. Very curious to see how much they also look toward some sort of soft landing or imminent recession. Honestly, it is a difficult time to parse through exactly where we're at. People talking about the potential embarkment on a new bull market. The S&P has turned positive. The NASDAQ lower after leading the charge. What I'm curious about is the Russell 2000 in particular, especially given that it has not led to date. We're looking at crude as well, up 2.5% on the NYMEX as we do look to OPEC Plus and the 1 million barrel per day cut that Saudi Arabia is embarking on solo. From New York, this is Bloomberg.
Tuesday, following the worst ever year on record, bonds are back. Bloomberg is live from PIMCO headquarters in Newport Beach, California, sitting down for exclusive interviews with CEO Manny Roman, income fund manager Dan Iveson, and more as the biggest names in fixed income reveal their bond market forecasts. It's a special episode of Bloomberg, The Open, with Jonathan Farrow at 9 a.m. Eastern, only on Bloomberg Television.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more, but
that's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With 2 more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He caught himself
self-made day trader. Yes. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. 30 minutes away from the start of trading on Wall Street, you're seeing basically a range-bound market, although crude very much leading the charge. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up, oil prices rising after Saudi Arabia's July production cuts. Big U.S. banks could face a 20% jump in capital requirements as Apple shares inch towards a record high ahead of its developers conference. We begin with a big issue on the cusp of another bull market.
Fear pivot to FOMO.
Equities have trading optimistic.
You're seeing markets move higher.
Equity market participants are very lucky.
The U.S. consumer has been strong.
We had the Q1 earnings results. Corporate America is actually doing all right.
The economy really hasn't slowed much at all.
The U.S. has been more resilient than anticipated.
The data, the economic surprise continues to be so resilient.
The U.S. is in a very different place.
American exceptionalism.
The U.S. economy remains a major engine of job creation.
All of this debt ceiling uncertainty.
A debt deal
removes it as an issue for the next over a year and a half.
The Fed, they got into the game late.
Skip, a pause, or hike. It certainly complicates it.
I don't think we rule out a 25 basis point hike in June.
I don't see any evidence for rate cuts.
A skip, not a permanent pause.
The Fed raises rates one or two more times.
Plenty of reasons to keep on hiking.
The Fed is going to have to make a really difficult judgment.
If this is a new bull market, it is one that people really dislike. Joining us now to discuss, John Hancock's Matt Miskin and Krishna Mamani of Lafayette College. And this is what strikes me. If this is the start of a new bull market, people do not like it. Matt, do you think that it is accurate to say that we are on the brink of a new kind of economic cycle that is starting to rear its head?
We do not believe so. We think we're in a late cycle environment where you're in this choppy trading range across asset right now, and you're getting this better than expected data, worse than expected data. It's all coming in relative to expectations, and whether or not it's beating expectations, market like it. If it's not, then the other side of the coin. Right now, fighting the tape is like fighting Mike Tyson, and it is a challenging backdrop to be relatively conservative in a late cycle environment. We're tilting toward the higher quality parts of markets, holding on here until we see more clear signal of a recession on our doorstep. We're not there yet, but for us, managing risk is a top priority.
Krishna, do you agree? Is it like fighting Mike Tyson and yet you need to stick with it?
Well, I think it's fighting imaginary Mike Tyson in a way. That is, people have been looking for this recession bugaboo for quite some time, and it really hasn't materialized. That in and of itself doesn't really mean that this is the start of a new bull market. I think if you kind of boil things down, it comes down to two things. Nominal growth is too high for stocks to tank, and rates are too high there's not enough slowdown in the economy for it to be a real start of a bull market. It may actually come about that way, but I think looking at the data today, making that assertion on both sides just doesn't hold. We are in a choppy market, range-bound market, and we'll try to break out. And if we do, and the economy remains where it is, we will probably give a lot of that back at some point later this year.
A choppy fog fighting a fake Mike Tyson. I love it. Happy Monday. Meanwhile, we do have on one side, perhaps it's a bull market. On the other side, you have Morgan Stanley's Mike Wilson, who's expecting a sudden pullback in corporate earnings to slam the brakes in the recent U.S. equity rally, writing, quote, hotter but shorter cycles persist. We continue to forecast an earnings recession this year that we don't think is priced, followed by a sharp EPS rebound in 2024, 2025. We recommend investors focus on stocks with defensive characteristics, operational efficiency, and earnings stability. That seems to be, Matt, what you were saying. There is this real kind of dilemma here. You can say we're not entering a new bull market, but can you get bearish? Can you fully rule out some of the areas that have gotten pretty beaten up and say they're not perhaps trying to yield a little bit more value here?
Yeah, I mean, for us, the value, for example, like financials right now, I mean, you're seeing the higher cost of capital really weighing in, the lending growth decelerate, but the solvency risk diminish. So that jobs report on Friday, and what a week last week. I mean, you got the ISM new orders index coming in below expectations, 42. So leading indicators still showing a slowdown, and then you got coincident data like the jobs report beat and causing a massive rally in these financial sector in some of these cheaper parts of the market. We would trim into strength, redeploy that capital into higher quality companies, great balance sheets, good ROE, things like that. And what we see in terms of earnings estimates, to Mike's point, is that in the back half, earnings estimates really ramp up. So it's nice in Q1 and Q2 that the estimates are negative 6% earnings growth, and you could come in better than that. But in the back half, the street is looking for a nice earnings recovery and inflection point. That's where the bar goes up, and it's going to be harder to beat. So we're looking for those that have lower estimates. Tech and healthcare have flat to negative earnings estimates. Those two places we think could actually beat on the upside over the year.
Krishna, do you agree that some of these areas are actually starting to see perhaps the greener shoots than other areas that have gotten bid up perhaps a bit more?
Absolutely. So I think people focus on the narrowness of the market and why the kind of the temporary breakout that we have cannot be sustained. I think if you look broadly, again, at a macro level, the most cyclical part of the economy, housing and construction, is not slowing down. If there was going to be a recession or really an earnings recession, you have to see some evidence somewhere. You know, and we added 340,000 jobs. So we can look at any piece of data and convince ourselves of any view that we have. But if you look at the underlying strength in the economy, it is just extraordinarily strong. Not something that anybody could have expected at this point with the Fed raising 500 basis points in rates. But it is what it is. And expecting a recession and an earnings recession in this context, it seems a little less likely in my view.
Some of the areas that perhaps have been sending a contrary signal has been the oil markets, which did get bid off quite significantly, sold off quite significantly. And now oil is advancing up about 2.5% plus or minus after Saudi Arabia pledged to cut 1 million barrels a day from its production starting next month. This was at the Vienna-based OPEC Plus meeting. Joining us now from there is Bloomberg's Manus Cranny. Manus, what did we learn, and how much is this pop that we're seeing in prices likely to stick?
I think it's going to be tricky, because I remember days when 1 million really meant something. Here we are. Let me give you a fresh line. The Saudi minister's just done another interview. His Royal Highness Prince Abdulaziz bin Salman. Talk about a good night's sleep and reflection. The Saudi minister says he's fed up with OPEC members not meeting their output goals, and says the Saudis will seek more transparency from Russia. So here we had the sugar rush from the lollipop, up 4% on the open, gave it a little bit back. The market reflects this is a real cut, make no doubt about it. It's almost twice the size of everything that you've seen before in the past 8 months. So just put that in the back of your mind. To me, that creates the floor. That creates the near-term floor in this market, because he's bought himself a call option, the ability to roll this cut forward, forward, forward. Coming into this, there were 3 dreams. The economic dream of Saudi Arabia, the war that Russia is lording over Ukraine, and third, the Emiratis wanted a higher production target. We've just worked it out. You gave up 1 million barrels a day for a month on a rolling basis, $2.25 billion. The dream suffers. It matters to keep this floor in place, and perhaps the upside can be retested if the Chinese reopening is delivered. But we have a global manufacturing slump. You've done the data. These are breaking headlines from His Royal Highness Prince Abdulaziz bin Salman. A good night's sleep. just shows you what a bit of reflection does. They want more, and they want more transparency from Russia.
How much is the cut some sort of signal as to what Saudi Arabia sees from China? And this is something that we were talking about with Ellen Wald earlier, this question around, do they know something that we don't with respect to cutting production even further?
Look, I think we've got to, sometimes you just got to stand back from this from a moment and go, every PMI that you've read out there, that I read out in the morning in the Middle East, that my colleagues read out in Europe, we have a global manufacturing recession. That is factual. Everything else that we're debating around the margins about hot employment, hot wages, etc., is about whether and when this recession slowdown comes. One thing I will say about this leader of OPEC, His Royal Highness Prince Abdulaziz bin Salman, he sees himself as this central banker of oil. He channels his inner Greenspan. He wants to be ahead of the macro. He wants to present himself as somebody that has the finger on the pulse. So to that extent, maybe there is something more malevolent. I'll leave you with this thought. The Saudis raised prices on selling their crude to Asia last month, despite the drop from China. 900,000 barrels a day down last month in terms of demand. But they raised their pricing. They are trying to balance this. This is about the economic dream of Saudi Arabia and delivering that transformation program that his brother, who runs the country, MBS, is in charge. So that is the driver, and it is about trying to be ahead of the macro.
Right now we're looking at Manus Credi. Thank you so much. As we're speaking with Manus Credi, we're looking at European gas futures jumping 20% on expectations of more Asia demand. This crossing the headline, the terminal as a hot headline. And I do wonder how much this is going to feature into expectations for inflation. Around the same time, we're also getting word from the ECB president, Christine Lagarde, saying no clear evidence that underlying inflation has peaked and that the ECB is fully committed to fighting inflation. Still with us, Krishna Mamani as well as Matt Miskin. Krishna, from your vantage point, how much do you think that people have underpriced some of the inflationary inputs from the likes of natural gas, certainly in Europe, as well as higher oil prices?
No, as the person speaking before me was indicating, I think if you kind of look outside the U.S., we are in a slowdown, and I think that is entirely factual. And I think that is the driver of oil prices and natural gas, and inflation expectations driven by commodities, far more than what is happening in the U.S. So I think the point is entirely correct. That is, the attempt of Saudi Arabia to cut production is really getting ahead of a slowdown rather than meaningfully trying to raise prices in an environment where that cannot be sustained, especially given what the outlook is in the rest of the global economy.
Matt, do you think that oil is still an indicator in terms of global growth, or do you think that right now it's kind of lost the signal and the noise just simply because of all the distortions and the varying inputs from China and the cuts and the production sort of ambiguity out of Russia?
We do, and really coming into this morning, what did we get? We get higher gas prices, so that's not good for the consumer. Interest rates are higher because inflation expectations are higher. That means higher cost of capital. That's not a great sign. And then the dollar's stronger, which the dollar's now more correlated to oil than it was in the past because the U.S. is such a big exporter. But all those three things are not good for the consumer or the macro, frankly. So we, again, think we're in a late cycle environment where you're getting this tightening through these channels, which eventually it works with a lagged impact. And I think that's the biggest misconception right now, or the thing that's missed, is that monetary policy works with a lag. So when you hear everybody saying everything's great, soft landing, we still haven't felt the lagged impact of a lot of this tightening that's coming through. And now OPEC's trying to push in a little bit more tightening right now. That, unfortunately, is going to have more of a negative impact in terms of the consumer.
Matt Miskin, Krishna Mamani, both of you are sticking with us, which we're really pleased about. Joining us now, let's take a look at which stocks are moving ahead of the opening bell. Abigail Doolittle. Abby.
Lisa, let's start out with the shares of Apple because they are popping higher. Potentially, if they were to close at this level, after they open at this level, it would be a record closing high for the shares and not so far away from a potential intraday high. This, of course, is the Worldwide Developers Conference is occurring today. Updates on all kinds of platforms and the excitement it generates. This stock now up about 40% on the year. Tesla also higher, 1.7% positive news out of China. They sold more than 77,000 100,000 made-in-China vehicles last month and sold nearly 76,000 in China, a 142% jump from the year prior. And then AI, Lisa, not so much today. We haven't shares of NVIDIA down 1.2%, Palantir, most stocks related to AI taking a little bit of a breather after the big rally that we had last week and the week before.
I like that you say that. A little bit of a breather, down 1% isn't exactly a massive round. Abby, thank you so much. Coming up, one crisis averted down in D.C.
It was critical to reach an agreement, and it's very good news for the American people. No one got everything they wanted, but the American people got what they needed.
Curtains closing on the debt limit showdown. Markets now bracing for a flood of U.S. debt sales. More on that next. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From New York City.
From London and Sydney.
From Washington.
From Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
It was critical to reach an agreement, and it's very good news for the American people. No one got everything they wanted, but the American people got what they needed. We averted an economic crisis, an economic collapse. We're cutting spending and bringing the deficits down at the same time.
Washington closing the books on weeks of tumultuous debt limit negotiations. Focus now turning to issues abroad at Asia's largest security conference. Pentagon Chief Lloyd Austin saying in a speech at the Shangri-La Dialogue, quote, "I'm deeply concerned that China has been unwilling to engage more seriously on better mechanisms for crisis management between our two militaries." His Chinese counterpart firing back, accusing, quote, "some big power of bullying other nations," telling the U.S. to, quote, "mind your own business." This coming as China says its Navy tracked U.S. and Canadian vessels throughout the Taiwan Strait over the weekend. Let's bring in the team down in Washington, D.C. Bloomberg's Anne-Marie Hordern and Kaylee Lyons joining us now. Anne-Marie, let's start with you with respect to some of those tensions. What did we learn? How much did we actually not ease some of the tensions, but ratchet them up at the Shangri-La Dialogue?
Well, there really was just this cordial handshake, and that's what Lloyd Austin described it. And then when he got up to talk about it, and this is, of course, with his counterpart in China, the Chinese Defense Minister, Li Shangfu, and when he got up to talk about it, he said, we cannot just have these cordial handshake. We need dialogue. The issue, of course, Lisa, and this is something I asked the president about at the G7, is that Li Shangfu is under sanctions from the United States. This has to do with transport of Russian military equipment that he oversaw in 2018. And it was under discussion that the administration potentially lift those sanctions because that looked like a big barrier in the way for China to saying they would agree to sit down with Lloyd Austin, but they didn't. So all we got from these two leaders in terms of engagement at this Shangri-La Dialogue is just a handshake, and that's all. And the rhetoric was just amped up even more. And as you say, all of this with the backdrop of a Chinese vessel coming very close to a U.S. military warship that was going through the Taiwan Strait. Everyone else at this summit is just looking around and saying, we want to see these two economies engaging, and they're not. And they are quite concerned of potentially what this could lead. Many saying they do not want to see what is happening right now in Europe with Russia's invasion of Ukraine taking place in the Asia Pacific.
That's on the international side. On the domestic side, Kaylee, there's a real concern. Yes, great, yay, we've got a debt ceiling agreement, but we now have to issue about net $1 trillion of T-bills in order to finance the government going forward starting this week. How concerned are people about the amount of liquidity sucked out of the market to pay for that?
Well, frankly, Lisa, here in Washington, I think so much focus was just put on the idea that the U.S. cannot default on its debt, getting a deal done and signed by the president, as we saw this weekend, less so about the ramifications of that, because avoiding default does mean, as you allude to, that the Treasury is open to borrow once again and is going to have to do so aggressively, considering that its cash balance has fallen below $23 billion as of June 1st. So in order to replenish those coffers, it is going to need to issue potentially $1 trillion or more of debt by the end of the third quarter. Just an absolute tidal wave of issuance that Bank of America has actually said could have the same consequence in terms of liquidity and economic implications as another quarter-point hike from the Federal Reserve. So we have to consider that. And then also the other ongoing risk at play here is that even though you have lifted the debt ceiling, put the risk of default on the back burner for another 2 years. We won't have to deal with it until 2025. Come the fall of this year, we still are going to have to pass a budget for fiscal year 2024 by the end of September. And there is a non-zero risk, according to Bank of America, of a government shutdown in October 1st, as we're likely to still see jockeying around that. So it's not to say that all the domestic issues, Lisa, are tied up nicely in a neat bow, even though we do have a higher debt ceiling now.
Kaylee and Marie, both of you, thank you so much for being with us. Still with us is Matt Miskin and Krishna Mamani. And I am wondering, Krishna, do you think that it is overplayed or underplayed, the amount of liquidity that would get sucked out of the system to pay for the net $1 trillion of T-bills the U.S. is expected to issue in short order?
So I think in an environment where the Fed is paying interest on excess reserves and you have more than $2 trillion in RRPs just sitting there, I think there is a way to kind of make it all work without it being disruptive at all. In fact, if all that happens is money comes out of RRP and goes into T-bills, nobody would notice it except for the Fed balance sheet. So I think this liquidity bugaboo is, again, another thing, a fake Mike Tyson being invented to kind of support a particular case. I think there will be some liquidity impact, but it won't be to the extent that people are making it out to be.
Krishna, just real quick before we get to Matt, are you getting full bullish? I mean, are you going full bull at this point?
No, not at all. I think, again, if there was some slowdown in the labor market, I would get bullish because that would mean that the Fed policy is having a meaningful impact. It isn't. So what I'm afraid of is we are, the Fed may have to do more. I'm hoping that is not the case, but that cannot be ruled out just yet.
Matt, your perspective on the T-bill issuance and what the implication is for the market. Is it a fake Mike Tyson?
Yeah, we do think it's a bit overblown, but what we're seeing is just tail risks keep getting chopped off. And that is the bullish argument right now, to Krishna's point, in essence, is that you keep getting these, big macro risks like the debt ceiling. And then, we come over these things and the wall of worry just keeps getting overtaken. And that is the bullish argument. To us, though, again, the labor market is tight, the Fed is tight, liquidity is draining. Regardless, we're in a late cycle environment. The economy has held up until now. But again, the leading economic indicators are not giving the all clear sign. It's not like the yield curve is uninverted. It hasn't. It's massively inverted still. There's only one way the yield curve uninverts, and that's usually, historically speaking, the Fed to cut rates. I know that now it seems like that's not going to happen, but eventually it likely has to happen.
Just real quick, Matt, 20 seconds. How much are you looking at credit really expressing the risks that you're seeing?
Yeah, tightening of lending standards, higher cost of capital, all that will weigh on the economy in time. Again, getting a bit more defensive into this risk-on rally may make some sense.
Matt Miskin and Krishna Mamani, both of you, thank you so much for being with us. Coming up, the morning calls, and later, Joanne Feeney of Advisors Capital Management joining us with her outlook for stocks as they edge even closer to bull market territory. That conversation still ahead at the opening bell. This is Bloomberg.
Tuesday, following the worst ever year on record, bonds are back. Bloomberg is live from PIMCO headquarters in Newport Beach, California, sitting down for exclusive interviews with CEO Manny Roman, income fund manager Dan Iverson, and more as the biggest names in fixed income reveal their bond market forecasts. It's a special episode of Bloomberg The Open with Jonathan Farrow at 9 a.m. Eastern, only on Bloomberg Television.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, KeyBank downgrading target to sector weight, expecting the resumption of student loan payments to weigh on consumers. Next up, Morgan Stanley downgrading Dollar General to equal weight, seeing too many macro uncertainties. And finally, Citi upgrading Ford to buy, pointing to the stock's valuation and strengthening demand. Coming up, the opening bell. We'll get that to you with Joanne Feeney of Advisors Capital Management. This is Bloomberg.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of trading, what you can see is there has been this shift upward in the S&P, up about 0.1%, even as you see a little bit of a decline in the NASDAQ. Meanwhile, the Russell continuing to underperform, down 0.3%. In the yield space, you are seeing yields marginally higher as people assess what the strong labor market report on Friday means for the Federal Reserve. We could see the 10-year yield a little off earlier highs, 3.74%. Euro weakness, dollar strength, 106.85. And crude markedly higher after Saudi Arabia agreed to cut output by 1 million barrels per day after they did not get any kind of commensurate agreement from United Arab Emirates. One stock to watch at the open is Apple. Shares climbing above its record close level, inching closer to a historic $3 trillion valuation. Abigail Doolittle has more. Abby, what will drive us to that valuation?
Well, the Worldwide Developers Conference today is certainly a piece of it, the excitement for what might be unveiled. But you know what's so interesting about this, Lisa? It feels a little bit like a stealth rally to me, because this stock now up 40% on the year. It's best year since 2020. Of course, after falling 27% last year, and now we have the stock basically at a new all-time high, very close to an intraday record high. But if it holds these levels into the close, it will be a record close. Investors, I think, Lisa, looking forward to next year, because this year we're actually modeled for negative growth on both the top and the bottom line. If you recall, a few years ago, back in 2016, when we had the first time of revenues dropping in about 10 years, it was a big deal. The stock fell a lot. Well, that could have been why the stock fell so much last year. Next year, we're looking for 9% bottom line growth. We're looking for top line growth as well. Anything could happen to those estimates, but I think that that's one piece of what's driving this stock higher on the day and on the year, Lisa.
I believe our team here has said $190 per share would bring it to that $3 trillion valuation. Abigail, thank you so much. From big tech to big oil, energy stocks getting a boost after Saudi Arabia's surprise production cut. Its energy minister saying that he would, quote, do whatever is necessary to bring stability to the market. Stability means higher prices. Katie Greifeld joining us now with more. Katie.
And that stability, definitely a windfall for some of these energy equities, at least for today. You have the likes of Chevron, Exxon, both rallying from the bell. Not quite as much as oil itself, but still a rally nonetheless after, of course, that surprise production cut from Saudi Arabia. Now, Jefferies analyst had a really interesting note out this morning saying that this is definitely positive at the margin for oil and for these equities, but longer term, it's still demand that's still the driving force for this market. So we'll see how long the legs are on some of these gains, but still, it's a needed win for a sector that's really struggled so far in 2023. That's after absolutely crushing it the past couple of years. Energy was the best performer for 2 straight years. It's the biggest loser this year, though, as demand has ebbed. It's down almost 8% or so far this year. That follows a gain of 59% in 2022, Lisa.
Katie Greifeld, thank you so much. Turning now to the financials, big U.S. banks potentially facing a 20% increase in capital requirements. That's according to reporting earlier this morning from the Wall Street Journal. Let's bring in Bloomberg's Kaylee Lines for more. Kaylee, what's the logic and the likelihood behind this potential capital raise?
Well, Lisa, frankly, we knew something like this was likely coming. The Fed already had been undertaking a holistic review of capital requirements under the Vice Chair of Supervision, Michael Barr, and that was before we saw multiple banks fail earlier this year, which really put an increased scrutiny on regulators and the prudential regulation of banks, specifically between $100 and $250 billion in assets, that saw some of those requirements rolled back under the Trump administration with the 2018 changes to how Dodd-Frank applied to banks of those size. And Michael Barr had hinted in the Fed's report put out after the failure of Silicon Valley Bank that may mean that things need to be tightened, and we could actually see those proposals soon, Lisa. The Wall Street Journal reporting potentially as early as this month. We could see an average 20% increase to the capital requirements of larger banks and banks with at least $100 billion in assets rather than the current threshold of $250 billion could be subject to those same rules. Now, of course, we're likely to see some pushback on this from the banks themselves, especially the larger ones. The six biggest, mind you, have built $200 billion more in their capital reserves over the last decade. And you may see political pushback as well. Of course, one side of the aisle on Capitol Hill has pushed back against the idea of doing anything legislatively to heighten regulation in the banks even after the failures. But this would be regulators acting really with their existing authority. So we'll wait to see what those rules potentially are, Lisa. But you are seeing the financial sector as a whole lagging early on in the trade today.
Kaylee Lyons, thank you so much. Joining us now is Joanne Feeney of Advisors Capital Management. Joanne, as we speak, we're seeing Apple shares climb to a new intraday all-time high ahead of their worldwide developers conference. This really comes as people have already rallied around these shares, up about 40% year to date. Question around how much this can continue. Joanne, from your vantage point, does big tech still have steam?
Yeah, good morning, Lisa. You know, there's a lot of future opportunity available for these big tech guys. The Super 7 has really driven the market up so far this year, comes on the heels of new information about the potential of AI. And what we saw was investors reevaluate the future earnings potential of these companies. And Apple may not be as thoroughly involved in AI as some of the others, but I think it's clear to investors that Apple has a stranglehold on the folks that use the iPhone and the other parts of the Apple, network, because it's just so, once you're in for a. We've seen a lot of institutional investors start to increase their positions because they were underweight a lot of these big names. I think that's driven a lot of the rallies so far. But looking longer term, we think there's a lot more room to go. However, given the recent rally, we probably shouldn't expect as much from these companies over the next, several months.
Have we moved away officially from them being interest rate sensitive?
No, not at all. I think what we saw last year, right, was the digestion of the higher interest rates on these valuations. And what we're seeing now is the reflection on the higher growth coming for them. And moreover, Lisa, right, we are expecting the Fed to pause probably here next week. And that means that interest rates going forward are, flat-ish to coming down over time. And that means that interest rates actually become a tailwind. And I think investors are also reflecting that when they buy these names now.
Okay, this is what I'm actually struggling with this morning. Yes, people are waiting for the next bull market. They're looking for reasons to buy. They're looking for reasons to not be bearish anymore. And yet we still have a Fed that isn't quite on hold. Maybe they're not going to raise rates next week, but they certainly have a labor market that still is incredibly hot. How do we get from there to rate cuts in the time frame that this market is currently pricing in?
Yeah, Lisa, I think that conundrum that you just described is exactly the problem. The Fed has still a lot of work to do to get inflation down. And that means that, investors should be prepared for things to probably be a little bit boring here, because probably see a pause. We're probably not going to see any rate cuts this year, although the market is expecting that, because that inflation problem is so intractable. And what we're seeing in the labor market suggests that the economy is still quite strong. Labor is still much in demand, and wages are still rising over, close to 4.5%. That's not a recipe for getting inflation down quickly. So it's going to take some time, and we probably aren't going to see rate cuts till next year. But the flattening of interest rate, that path of interest rates, is what I think has taken the headwinds away from the higher valuation technology and growth companies.
As we shift from tech to the rest of the universe of equities and beyond, just in terms of what hasn't followed through with the rally to the same degree that the Apples and the Metas of the world has, we have to turn back to oil and this idea that Saudi Arabia is concerned enough about how low prices are that they are making a unilateral 1 million barrel per day cut in production. How much does that give you faith that there is some more value in some of the equity names that haven't really done so well?
You know, Lisa, this has been a really frustrating time for a lot of investors because they see these big tech names going up, and if they're diversified more broadly, across the market, looking at some of the longer growth potential, they're not seeing as much of a lift to their portfolios. We're getting a lot of questions from our clients saying, is this a time to be going into equities given how much the market so-called has risen? And the market really hasn't risen. It's two markets. It's the Super 7, and then it's the rest of the market, which has barely budged. And, I think that investors need to be patient here and recognize there are still opportunities because the rest of the market really hasn't gone up that much because of these recession fears, because of the concerns about what the Fed is going to do. But longer term, we're seeing the infrastructure bill, the Inflation Reduction Act, there's good government spending going on to support various manufacturing industries. There's a real opportunity here among those names that really haven't moved much this year.
How much are you shifting out of bonds and into equities? And I ask because Mark Heffley of UBS doesn't seem to have much faith in the recent equity rally, writing, quote, we continue to prefer bonds to equities in our global strategy, favoring defensive, higher quality segments of fixed income as they offer both attractive absolute yields and a hedge against growth and financial stability risks. Do you agree with that, or is that not really working given that a lot of the stocks that are out there have not participated in the gains so far this year?
Yeah, well, the bond side of a client's portfolio can do very well in this environment. They're getting terrific yields, although over the long term, those yields are wonderful for a bit of cash flow, but they're really not keeping up with inflation so much. So for long-term appreciation in portfolios, you still need to be in equities. And there are ways to be in equities that are defensive too. You can buy, higher dividend yielding stocks. Some of our balanced strategies are putting up, 4 or 5% dividend yields, and you get some total return over time with appreciation as some of these stocks that haven't performed well start to recover, as some of these recession fears, potentially fade, and as some of those government spending programs help to boost, the industrial companies, for example.
How are you positioned in terms of bonds versus stocks right now?
It's up to the client, Lisa. I mean, it's really up to them and their risk preferences and their time horizon, right? So somebody pre-retirement may be more heavily, 80-20 equity to fix. Somebody in retirement that, really needs to have a better handle on a more stable portfolio is going to be more, potentially 30-70 or 40-60. So it really depends on the client, their time horizon, and their risk tolerance to determine that. But total return and appreciation of the portfolio is still going to come from the equity side. And if you have a sufficiently long horizon, I'm talking, 3-5 years, it's not a bad time to be more broadly exposed to equities.
Let's say your client brings to you Morgan Stanley's Mike Wilson and some of his recent research, where he said, quote, the boom-bust period that began in 2020 is currently in the bust part of the earnings cycle, a dynamic that's not yet priced in our view. And what happens if they say to you, there will be a better entry point? What do you say?
I say, excluding those Super 7 that have done so well, the entry point is probably really pretty good right now in equities. And, for the investor that has a 3 to 5 year time horizon, the boom-bust cycle happened last year. We saw that major pullback. We saw those recession fears come in, the global geopolitical risks come in. Now we're starting to see investors look beyond the recession risks, seeing that strong labor market. Yes, we might get a recession. We're probably thinking it's going to be next year and it's going to be mild. But, the investors should be looking longer term than that. And there's some really good opportunities out there, stocks trading still below 15, 16 times that have good long-term potential. So this isn't a time to avoid equities, but it is a time to pick and choose. That's why we only own, 40 to 50 stocks in a client portfolio, so we can be pretty selective at this point.
Joanne Feeney, thank you so much for being with us. Coming up, shares of Apple hovering at record highs, hitting them on an intraday level ahead of its developers conference. We'll look ahead to the big event in Cupertino with D.A. Davidson's Tom Forte. That conversation coming up next.
What's happening on Wall Street?
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
So is there more pressure when you're trying to win a basketball championship than when you're trying to please investors? Where's the greater pressure?
Oh, I think it's definitely trying to win a championship. It's hard because a lot of, like when you invest, and you know this, when you're investing, you can control a lot more things. When, you know, on a basketball court, you can't control whether somebody's going to make a shot. You've got to get lucky.
And what's the greater pleasure, making 5 times your money on a distressed debt investment or winning the NBA championship?
They're both fabulous. I wish I could do one each year. That would be great. But I think there's a great feeling in being right on an investment, that you've done a tremendous amount of work and you've made money for your clients, which I think is great. I think winning a championship it's a very surreal feeling because there's a whole city or state that is actually behind you. You know, we had 70,000 people at the finals, and we had them all outside. You had 17,000 in the stands, and then literally like 60,000 people outside. And when we won, like just the joy that you had brought to the city was phenomenal.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
AI adds another $30 to $40 per share to the Apple story. From a user perspective, be giving users the ability to, on the services side, from cloud, from music, from TV, to more and more of the devices, cross-pollinating between different devices, that you're going to be able to get different information within the actual Apple user. And I think what Cook's going to talk about is AI could be really another foundation, another monetization of the Cupertino growth story.
And that monetization has led to about a 40% pop in Apple shares so far this year. New all-time highs on an intraday basis for those shares. And the S&P, this has really helped to fuel the fact the S&P 500 has now risen 20% from the October low, set to enter a bull market, except only with 7 stocks, evidently, with big tech leading the charge, which is the reason why investors are so focused, so trained on the Apple's Worldwide Developers Conference, which happens today. Shares have been hitting all-time highs. People expecting the tech giant to unveil a mixed reality headset that could potentially help fuel future growth. Joining us now is Bloomberg's Caroline Hyde with more. Caroline, what are we looking for today?
All about the headset. Yes, you're going to get a sprinkling of operating system upgrades. You're going to see that for the watch. You're going to see that for the Macs, maybe a new lineup of a Mac. But really, ultimately, Lisa, this is about VR, AR. This is about a headset that's going to be selling at about $3,000. They're not thinking of selling many, about 900,000 in the first year. Just compare that to the, well, 200 million that they send in terms of overall iPhones per year. But this is a focus on reinventing what basically Meta hasn't really been able to make a killer product. The fact that it's going to be lighter weight, aluminium, carbon, graphite, the likes of glass going to be going into this. Initially, Tim Cook thought this was going to be a sort of like a pair of glasses you'd be able to wear all day. It's not that. It's like ski goggles, more like. But this is going to reinvent the wheel. This is going to be aspirational. And this is going to be something that they hope is going to be productivity-led, gaming-led, health-led as well.
Caroline Hyde, thank you so much. D.A. Davidson analyst Tom Forte commenting on Apple's expected AR headset launch that Caroline was just talking about, saying, quote, this could represent its most significant new product launch since the iPhone and the biggest new product launch during Tim Cook's tenure as CEO. Tom Forte joins us now. Tom, can you talk about why it's so significant if at first they're not going to roll it out in so much scope in terms of the number of units sold, and it's going to have a pretty high price tag of about $3,000?
Yeah, those are excellent points. And the way that I think about it is when you go back to 2007, when they released the iPhone, the real power of the iPhone came with the apps in the App Store. So I think it's excellent that they're going to launch an AR/VR headset. And I do believe this is potentially by far the most significant new product news during Tim Cook's tenure, but it's going to take time. There needs to be content. There needs to be things that people can use when they use this augmented reality, virtual reality headset. But I think it's exciting as it is the most significant product launch in a long time.
How do you value some of these names that have gotten bid up so dramatically? I mean, I think of NVIDIA as sort of a front runner in that game, but Apple as well. How do you give a valuation to something at a time when a lot of people thought that you'd already brought forward a lot of the growth in the pandemic, and suddenly we're looking at a new wave from AI, a new wave from new innovations?
When Apple trades at an all-time high or near an all-time high, as it is today, I think investors are starting to embed sales expectations and profit expectations for significant new products, such as this AR/VR headset, and I think potentially over time, an autonomous driving vehicle. So I think that for Apple, you need to expect that there's going to be more than the iPhone, as wonderful as the iPhone product is, to continue to drive the stock higher, given that it's trading at near or at all-time highs.
What are you expecting to learn? We know that there's going to be the AR headset unveiled today at the conference. Is there anything else that you're looking for in terms of indications about strategy or just growth potential?
Yeah, so for me, again, the key is, what is a consumer going to do with this device? So it's wonderful to have an excellent piece of hardware from Apple, but if you don't have games to play or content to consume, then I think it's going to be a tough sell for Apple as it waits for the ecosystem to catch up with the hardware. So basically, I'm looking forward to details on what exactly does Apple think consumers are going to do with this device, especially over the next 12 months.
We're probably not going to hear too much about artificial intelligence at today's conference, but what are you looking for just more broadly in terms of how Apple will deploy it? And I think about the AR headsets as being sort of a prime candidate to possibly be some sort of foil for some new artificial intelligence, ChatGPT, that can help us in our daily lives.
Yeah, so I think Meta Platforms kind of put it best when they said that their long-term vision is the metaverse, but in a near-term vision, Meta Platforms is leveraging artificial intelligence to improve the consumer experience on Facebook, Instagram, and elsewhere. So I think for Apple, if the AR/VR headset is a long-term vision for Apple leveraging artificial intelligence, what are they going to do on a near-term basis? You think about some of the functionality they've added to their iPhones, SOS as an example, things of that nature. You think about Siri. So there is things that Apple can do on a near-term basis with artificial intelligence while we wait for this AR/VR headset to gain traction.
Tom, do you think that any of the tech giants are overpriced at this point?
So specifically as it pertains to the two that I cover, Apple and Amazon, the answer is no. I think the important thing here for Apple is that you have new product news. I think if we were solely baking it on iPhone sales and things of that nature, it might be challenging. And then for Amazon, it's certainly a slow period of time for e-commerce, and the slowing growth in their AWS business is concerning. But I do think their AWS business essentially is the backbone for a lot of this artificial intelligence efforts. And we are looking for trends potentially to improve on the e-commerce fronts as they do a better job managing their expectations. So for those two, I think there's still upside to where the stocks are trading today.
Tom Forte, thank you so much for being with us. We really appreciate it. Meanwhile, we do have some breaking U.S. economic data just crossing the terminal. Bloomberg's Michael McKee joining us now with more. Mike.
Well, we're setting up for the ISM services number at 10 o'clock. We get the S&P Global Services PMI for the United States. Comes in at 54.9. That's down from 55.1. And the composite, 54.3 from 54.5. So very little change in those numbers. And if they're any indication, maybe not a lot of change coming in the ISM Services Index, which is due at 10 a.m. Wall Street time. And Lisa, that is expected to rise a little bit. So we shall see.
Mike, thank you so much. I do think it's interesting, a downside surprise on services PMI. I mean, maybe this is indicative. We shall see. Coming up, the market moving events that you need to be watching. That's next in our trading diary at a time when stocks are reaching a bull market. This is Bloomberg.
Tuesday. Following the worst ever year on record, bonds are back. Bloomberg is live from PIMCO headquarters in Newport Beach, California, sitting down for exclusive interviews with CEO Manny Roman, income fund manager Dan Iveson, and more as the biggest names in fixed income reveal their bond market forecasts. It's a special episode of Bloomberg, The Open, with Jonathan Farrow at 9 a.m. Eastern, only on Bloomberg Television.
Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Farrow. A quick look at markets. We are seeing just up off some of the highs of the session, but still the S&P looking to get toward that 4,300 basis. Time now for the trading diary. You need to be watching this week. U.S. durable goods and ISM services at the top of the hour. Then later today, Apple will have its Worldwide Developers Conference. UK Prime Minister Rishi Sunak visits President Biden in Washington on Wednesday, and we'll get U.S. mortgage applications. And then on Thursday, another round of jobless claims. This was Countdown to the Open. This is Bloomberg.
don't think we can replicate Tesla. Tesla is a unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Going to keep rain World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
I won! Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees. But for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack at the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Benegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Benegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Benegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Benegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities in the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
This is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders